Why don't we all start grabbing our seats and getting set? Apparently there's some problems on the metro today. There's I gather a train stuck in the underground, so some folks may be on that and may be coming in late. But I think we'll get started nevertheless. And I thank everybody for coming today, and certainly thank our panelists for being here. I'll start with a few remarks and then hand over to my fellow commissioners. But before I do, is there any housekeeping business that we, just in terms of calling the meeting to order or anything, Ajay, that we need to? No.
Just done it.
Okay. Well, welcome to the second meeting of the CFTC's reconstituted Energy and Environmental Markets Advisory Committee. And I'd like to welcome 4 new associate members to the committee and to today's meeting. William Jones, CEO of Jones Petroleum and JP Capital Insurance from Jackson, Georgia. Thank you for being with us, Bill. Martin Bates, President, Strategy, Energy, and Development at Alcoa from Pittsburgh, Pennsylvania. Sorry. Oh, and Michael Padgett's in his place. Thank you, Mike, for being here. Joseph Allen, Director of Energy Policy for Caterpillar and Solar Turbines, fulfilling our environmental portion of our mandate. Thank you for being here. And Andrew Soto, the Vice President for Regulatory Affairs with the American Gas Association. Thank you. Thank you for joining the committee and for supporting its important work. In February, the committee met and focused on the CFTC's proposed rules to impose, for the first time, federal position limits on American energy and environmental markets. That meeting identified several areas where the current position limits proposal would be problematic. 1, the proposed limitation on the bona fide hedging exemption to only a limited number of enumerated hedges leaves many other strategies, including bread and butter energy risk management strategies, ineligible for the bona fide hedging exemption. And also, secondly, the increasing evidence of its distinct lack of liquidity and widening bid-ask spreads further out on the curve, perhaps resulting from, as some participants noted, insufficient speculation that the CFTC's position limits proposal would exacerbate. In my mind, we must find an approach that addresses these problematic aspects of the proposed rule so that U.S. market participants may continue to manage the risks associated with their production and price. Along these lines, I had the privilege last week to spend in the Midwest meeting with many agricultural producers, such as dairymen, pork producers, and row crop farmers. And the number one concern of producers of corn, soybeans, pork, and dairy is what price will they get paid for their product come harvest time. The spot price they're paid for these commodities is what puts food on their tables and pays for their kids' school supplies come the fall. So you can understand their worries this summer over the current tumbling in worldwide commodity prices that has been widely reported in the financial press. These falling prices led me to ask the CFTC's Office of the Chief Economist for some basic data covering the 28 commodities covered by our position limits proposal. And the information they provided me was stark. Across the 28 commodities that will be covered by the proposed position limits rule, there has been a dramatic double-digit decrease in prices since December 2010. In fact, since the year that the Dodd-Frank Act was signed into law, there has been a 42.6% decline in the 22 commodities covered by the Bloomberg Investable Commodity Index. It was apparent from my meetings in Iowa and Minnesota and Illinois that many American agriculture producers have reduced their hedging activity in the past few years, making them more vulnerable to these type of volatile price swings in U.S. commodity markets. If and when the Commission moves forward with a position limits regime, we must be absolutely certain that we do not make it more difficult for American agricultural and energy producers to protect themselves against huge declines in commodity prices because of wooden or inflexible rules. If the current collapse in world commodity prices continues and the position limits rules are not made more workable, we may be imposing burdens on hedging risk at precisely the wrong time. I trust this Commission has that concern and foresight to avoid such a result. Now let me briefly highlight what the EMAC will cover at today's meeting. The first panel will consider a framework for a CFTC authorization of the exchanges to grant bona fide hedging exemptions for legitimate risk hedge reducing strategies. This approach was recently commended by Chairman Massid. The major commodities exchanges, some EMAC members, and the CFTC staff have all expressed some interest as well. So the first panel will discuss a minimum framework for providing discretion to the exchanges and CEFs to review and approve, where appropriate, non-enumerated hedging exemptions for federal position limits. Of course, this authority would remain subject to CFTC oversight. Yet handled properly, this has the potential to make the current proposal more workable, which many commentators have said is needed. In addition, the first panel will explore the possibility that exchanges can administer a position accountability regime as a way to soften the impact of declining liquidity outside of the spot month. Our second panel will examine the possibility of adopting a phased federal position limits rulemaking that would begin by covering the spot month before turning to rules for the outer months. This approach would avoid exacerbating the present liquidity problems outside the spot month that were identified in the February EMAC meeting. It would give all market participants the opportunity to adjust to the new process of tracking and reporting commodity swaps along with their futures and options. It would also provide the CFTC with additional time to obtain better data about the over-the-counter market for physical commodities before setting rules for later implementation. I note that the CFTC has had good success with phased rulemaking, most recently with its phased approach to implementation of the swaps clearing mandate. I hope to learn of any reason why a similarly phased rulemaking would not be similarly successful in the case of position limits. Our third and final panel will consider trade options and forward contracts with embedded volumetric optionality. As most of you know, the CFTC has started taking action to strike the right balance in its regulation of these very important transactions. We recently finalized a revised implementation of our 7-part test for EVOs to provide market participants certainty on whether their physically settled, often long-term contracts must nonetheless be treated as swaps because they contain embedded volumetric optionality. So the third panel will provide us with an update on the degree to which the recent actions by the CFTC have resulted in the intended regulatory certainty. In addition, we will consider whether there is more the CFTC can do to ensure that these vital transactions are not subject to burdensome regulatory requirements. With that, I thank you all, and I thank the witnesses who have prepared thoughtful presentations. And I thank the CFTC staff for working so hard to arrange this meeting. And finally, I want to recognize committee member Michael Cosgrove, who has graciously agreed to chair today's meeting. Thank you, Michael. And I now turn to Chairman Massid and my fellow commissioners to make their opening remarks.
Thank you, Chris. First of all, welcome, everyone. It's great to see all of you. We really appreciate the time you've taken to be here and to participate in this. These discussions are always very beneficial. I want to thank in particular those people making presentations, because obviously you've taken the time to prepare those and put a lot of thought into it, and we appreciate that very much. I want to thank Commissioner Giancarlo for organizing this, and his staff in particular for all the work that they've put into it, and the rest of our staff for facilitating the event. I'm going to be very brief. I look forward very much to today's discussion. On the position limits rule generally, we've obviously taken a lot of comments. We've reopened the comment period a number of times. We're digesting all those comments, and you know, I think all of us take these issues very seriously and want to come out with a rule that addresses the congressional mandate of reducing the risk of excessive speculation while at the same time enabling commercial participants to hedge effectively. On the non-enumerated hedges point, yes, I have noted that I am willing to look at this issue, so I'll be interested in what participants have to say. Let me just say, if we were to decide to go down this road, then I would expect us to come up with a proposal and solicit public comment on that so as to give everyone, not just those people in this room, an opportunity to comment. On the trade option and EVO issue, as Commissioner Giancarlo noted, we have taken action on EVO. We have a proposal out there on trade options, and the comment period, I think, is closed on that. I would hope that we can move forward on that soon. Finally, I did note Commissioner Giancarlo's statement on prices and the fall in commodity prices, and I share his concern or his recognition of the concern of many members of the agricultural community on that. And I agree with him that that does make it important that they can hedge effectively. I did note also his reference to the fact that the decline in prices has been since the passage of Dodd-Frank. Actually, if you look at the data, in a lot of commodities, prices went up after the passage of Dodd-Frank and then came down later. I know Chris is very well capable of distinguishing causation from correlation. So I think it is important to recognize that prices are shaped by a lot of things, and it's important not to draw too much from a correlation. And again, as I say, the correlations in some cases actually would suggest a different point. So I think all of this, though, the decline in prices overall, I think just reinforces the need to come up with a position limits regime that, again, meets the congressional goal of limiting excessive speculation or the risk of excessive speculation while enabling people to hedge effectively. So I look forward to today's discussion. I'm sorry I won't be able to participate in all of it, but again, appreciate your presence.
Chris, you want me to go next? Yeah. Good morning. Welcome. Nice to see everyone again. Chris, thank you for convening the meeting today. Looking forward to today's discussion. I, too, had some meetings last week and learned a great deal. The meetings were focused on the ag sector and included folks from the producer community, the cooperative community, serving as intermediaries, again, in the ag sector primarily, manufacturers, and significantly sized merchants. And it was a fascinating set of meetings, and we learned a great deal. There certainly should be some concern based on the fact that so many people's livelihoods depend on the prices of commodities. And so the fact that there has been such a decline is obviously very, very relevant. I thought another thing that was interesting to hear is that at least in the ag sector, and we've heard in previous meetings, both in IMRAC and perhaps even in EMAC before, I can't remember for sure, but the ag derivative markets seem to be functioning very, very well. And I guess as we focus on position limits, I think that's an important thing we need to bear into account. Accessibility to the markets seemed to be quite good. There were no complaints, and again, this is just a subset of the marketplace that we visited with, but no complaints about being able to access the market. The one thing that was interesting to learn is that while some used to do OTC contracts in ag products, that no longer takes place, but they're finding ways to manage risk in other ways. So I thought in a lot of ways it was heartening to hear a lot of what we heard, at least in the ag space, that the marketplace seemed to be functioning quite well. Liquidity was pretty good. Customer service was pretty decent. among the IB crowd, and customer service and accessibility again seemed to be pretty healthy from the FCM perspective. So all that was very, very positive. As the chairman said, the statute obligates us as a commission to impose a federal position limits framework. I've said that before multiple times now. But what it does not obligate us to do is to impose a framework that's, in Chris's words, wooden and rigid, or otherwise divorced from the realities of the marketplace. Those words do not appear in the statute. We're not required to do that. So we have to be cognizant of the market dynamics in these cash markets as we put together a policy for limits in the derivatives markets. And so I'm especially interested in the first panel. And again, this is something that I've spoken about before when we repropose a position limits rule. There has to be a workable way that we deal with non-enumerated hedges. I understand there could be some work to do in terms of what also might be included as an enumerated hedge, but beyond that, we have to bear in mind the realities of the marketplace and the realities facing the commission about how, as a commission, we're going to deal with those transactions that do not neatly fit into the definition, one of the enumerated hedges defined in our rule. So it seems to make a heck of a lot of sense that we would try and leverage both the expertise and the resources, frankly, of the exchanges to help us in that effort. So especially looking forward to this first panel as well as subsequent panels. And again, it's great to be here. It's great to see all of you here convened, and looking forward to the meeting. Thanks.
Great. Thank you and good morning. It's good to be here for another meeting of the Energy and Environmental Markets Advisory Committee. And for those of you who travel from out of town, thank you for braving DC's less than pleasant weather today. We're covering some important topics, and I look forward to hearing the views of this committee. I've had the benefit from hearing from many end users, such as farmers, ranchers, energy producers, utilities, and manufacturers this past year. I appreciate the time you all devoted to share your concerns and for your continued commitment to fulfilling the vital role you play in our economy. The Commission recently released new guidance regarding forward contracts with embedded optionality. As I've said before, I support the Commission's efforts to provide legal clarity regarding these products. And it is important that we provide relief so that end users, particularly those in the energy and agriculture spheres, can continue to utilize these contracts for hedging and also have certainty about their treatment. Yet I think we need to do more. Options and forward contracts are distinct categories under the Commodity Exchange Act. If a contract or some portion of a contract meets the definition of an option, that portion which is an option inherently cannot be a forward contract. A product that is embedded with volumetric optionality, or EVO, may be a forward if the optionality is utilized as a forward. If, however, an entity attaches EVO to a forward and uses that product as an option, the overall product is not a forward and cannot qualify for the exclusion. I believe the Commission does have a route for providing the clarity that market participants are seeking, and I have proposed that the Commission use its exemptive authority to provide an additional, easier solution for obtaining the relief that these stakeholders are requesting. I look forward to reviewing the comments the Commissioner receives and working with my colleagues here to see what more we can do. I also want to speak briefly about position limits. Nearly 8 months ago, we reopened our comment period on position limits, something, frankly, we've done quite a bit recently. At that time, I said, I support reopening the comment period, but we cannot allow this rule to linger indefinitely on our docket. It's been over a year since we reopened this rule and nearly 4 years since it was first proposed. It has now been nearly another year. Spring has turned into late summer, and this rule still has not been finalized. Having reviewed the summaries of the comments submitted over this past year, I think we've seen pretty much all of the original comments we're going to see. In the last comment period, many commenters restated previous ones, in some cases almost identically. So I get the sense that commentators not only feel strongly about their positions, but want to make sure that we are hearing from them loud and clear, and we do. I therefore do not think it makes sense to reopen the comment period for this rule again, unless it is necessary to seek public input on some new additional approach or proposals that the Commission has for addressing certain concerns. I think we really need to buckle down and finish this rule. Thank you again to the committee and the sponsorship of Commissioner John Carlo for providing this opportunity to hear from you today.
Thanks, Sharon. Thanks, Tim, and thanks, Mark. We'll now hand it over to our committee chairman, Michael Cosgrove. Thank you, Michael.
Okay, well, so we have our first panel, how can exchanges help implement federal position limits? And I think without any further ado, well, actually, should we introduce ourselves, or having done that once before, is that reasonable?
We have a pretty tight agenda, Mike, so I think maybe we'll dispense with that if that's all right. But maybe we can have the panelists introduce themselves.
Okay, great. Well, I think without further ado then, if you guys would like to introduce yourselves and begin, we're all ears.
I'm Ron Oppenheimer, and I'm here representing the Commercial Energy Working Group.
I'm Tom LaSala. I'm the Chief Regulatory Officer for the CME Group.
Americas, Market Regulation with ICE Futures US.
I will begin. First on this panel, I'd like to speak. Can you hear?
Just get close to the mic.
Got it. I'd like to speak to what I've called the impact analysis covering the period of June 1st, 2014 through June 30th, 2015. What I'm trying to illustrate for the committee in this particular presentation is basically a furtherance of materials that were touched on and presented by the CFTC in the rulemaking, generally speaking under Table 11A. So in that table, what effectively transpired was the Commission detailed out impact points, how many participants would have been affected by the imposition of position limits, whether it be single month, all months, spot month. I'm focusing here on single months and all months combined. And the rationale that I'm looking to pass forward here is that I'm overlaying, louder, sorry. I'm trying to overlay what that imposition of those limits could have to legitimate positions held by commercials as well as non-commercials, and how those positions, if affected by the limits, will effectively ill affect the workings of these markets. So today, I think everyone is aware that, and I've highlighted in this chart, various energy contracts as well as metals. I'm going to focus on energy, but we're operating in an accountability paradigm today, not limits. And I want to speak to the details of the chart in just a moment, but I think it's helpful if I could first just reinforce a couple of critical concepts on how that accountability paradigm is operating today. So to further and enhance liquidity, while being mindful of concentration, we effectively set certain thresholds for open interest and monitoring all these markets. And they're different, meaning that if there was no open interest in a particular month and Eric and I traded 500 lots opposite each other, the position would be concentrated. It's 100%, and the open interest is 500 lots. The point is that you can't impose a liquidity or a concentration standard there. You would just squelch the formation of liquidity. So we set on a market-by-market basis and operating the accountability paradigm certain thresholds, and they vary. So when certain back months get to, or all months get to a certain threshold, we begin looking and managing concentrations in those contracts. And the profile of how we look at that concentration, frankly, across the curve is different. As you might imagine, in the nearer term months, we might be becoming more sensitive with positions when they're in the 20 or 25% of open interest range. As you get further out the curve, that percentage could, in fact, increase, and it does. So I think these contracts have been managed under the accountability paradigm, and I'm going to use the word successfully. Successfully because as I go through some of the examples here, where I'm going to show you the impacts, not only on the number of participants, but a greater level of granularity as to how many days these participants were affected within the target period, June 1st, 2014 through June 30th, 2015, and also the magnitude of how many positions over the said limit those participants were, as well as what, and I chose to highlight the peaks, what those peak concentrations actually looked like. And what I think you'll find and conclude is that accountability paradigm did operate effectively. And in fact, if we imposed the single and all months limit as proposed with the formula, and I denoted what that proposed limit would be, you will have significant impacts. And so let's take an example, if we could. I'm going to use the single, I'm going to focus up at the top. We've broken this chart out by non-commercials, commercials, and then I did in fact present an aggregate view. So I'm going to look at RBOB in the non-commercial category. The proposed CFTC limit per the formula, 11,800. The number of participants over a single month, it's an asterisk because it means there were fewer than 4. We chose not to identify specific numbers below that level. We didn't want folks to try and infer who a participant might be. So with fewer than 4, so 3 or less, the average amount over a single month in RBOB for that period was 2,696 positions. The peak was 6,255 positions, so a peak of one of those 3 or less was that 6,255, and the peak concentration percentage was 17.20%, and the number of days that the accumulation of the parties, so those 3 were over amongst them, a total of 217 days. So it may have been 117 days if there were 3. Looking at the all months for affected participants, but again, what was the average of the parties' positions that were in excess of that 11,800? 5721. The peak, 9934. The percentage of the peak, 5.59%, and the affected days, 291. So what I'm concluding and putting forth to commissioners and to the committee is that these positions were allowed to exist in excess of what the would-be limit would have been. I'd assert to you, with no casualty insofar as ill affecting the market. In fact, in this example, and if the committee would want to go through others, I'm happy to, those non-commercials were, in fact, providing valuable liquidity. And I'm not saying liquidity in the context of they're at the top of the central limit order book providing a bid-ask all day. No, they're taking on positions opposite commercials in the marketplace who need that liquidity. That liquidity yields open interest. That open interest yields more liquidity to allow these markets to, in fact, function properly. So I'm not dismissive that where in any means that positions should be unlimited. In fact, across the period, there were a number of instances, 44 in fact, where we reached out to participants to question because they broke through one of our thresholds. We questioned them about the details of what that position represented, and we set for them a framework of where I would say the sensitive points are in terms of concentration. So by effectively reaching out, engaging, and illustrating to market users, whether it be in RBOB or any of these markets, I think the marketplace understood where the sensitive points are, and we avert the circumstance where we have to, in many instances, order people to either reduce or not increase or hold. We did have 3 of those instances where we did have to say hold your position, and they did. So again, some context. I'd like to, if I could, one more example in the commercial category, and then certainly per any questions on any of the particular commodities, I'd answer them, or any more generic questions, happy to field them. But if we look at RBOB, again now in the commercial category, that same limit, the affected parties in the single, 3 or less, you see the average overage, the peak 12,000 and change, a 16.44% peak concentration, 123 days, across those participants, moving to the all months, 5 participants, the average 49.81, the peak 13.854, the peak percentage or the concentration 5.48 for a total of 537 days that commercials were affected. And while I think we all know, and we're going to be talking later in this panel about commercials and exemptions as proposed today, things change. So where some of these parties, if strict limits were administered per these levels during this period, if the paradigm for exemptions was narrowed, constricted, some of those commercials may not have been able to maintain those open positions. And while I think it's the goal of many sitting in this room today to further explore, as the chairman and the commissioners have said, getting to the right place on the exemptions, I'm simply pointing out that you're getting a clearer, I believe, profile here of what that impact could be to commercial users as well as non-commercial users. So again, I'm certainly open to speak with any level, whatever level of detail you would need on any of the other markets. I focused on the energy. I did highlight the metals for everyone to take a look at, and certainly available to take any questions. Thank you.
Shall we continue and have our questions at the end of the panel?
Sure.
So is that all right?
Absolutely.
Tom, one real quick question. For purposes of your data there in your presentation, how do you define commercials?
The commercials would be, I think, very similar, Commissioner Weegan, to how the Commission defines them in the COT. So you'd have producers, refiners. There would be oil traders in that category. We would have also included swap dealers in that. So it would be the swap dealers and the others I just mentioned.
Good morning. Again, I'm Ron Oppenheimer, representing the Commercial Energy Working Group. And before I begin, I want to thank all of you and the Commission staff for spending so much time on this rule. I know it's been extensive, and it's very much appreciated. The Commercial Energy Working Group's view has been all along, if we're going to have a position limits rule, let's work to get the rule right. And we really appreciate the time and effort that you all have been putting in to do that, to focus on that same objective. My presentation today is really a continuation of the presentation I made at the last EMAC meeting. At that time, we discussed how the narrow definition of bona fide hedging in the proposed rule would limit some of the risk-reducing behaviors of commercials in the marketplace currently, and how eliminating their ability to reduce their risk would add cost into the system, and how that cost ultimately is borne by consumers of energy products. So it's an important consideration. At the meeting and since, and as has been said in some of the opening statements, several of you have expressed a willingness to consider relying on the work that the exchanges do to consider where non-enumerated hedges might fit into the framework of a position limits rule. And we think that's very constructive. The exchanges have the knowledge, the expertise, and the regulatory incentive to carefully scrutinize the exemption process, and they already engage in a parallel process for their own interest in self-regulating, in ensuring convergence and orderly liquidation of futures contracts as they come to expiry. So over the past several weeks, the Commercial Energy Working Group has engaged in a lot of discussions with ICE and CME over what a possible framework could look like. We'll both describe it today really not as advocacy, but as the basis for a discussion as to whether it provides a viable solution that could break the logjam that has existed in this space for however long you want to count it, at least 5 years, and allow us to move forward on this important issue. So if we could go, the benefits of relying on the exchanges are pretty obvious. The first is that it avoids resource duplication. Secondly, it capitalizes on the depth and breadth of the designated contract market's experience in evaluating hedging strategies in the energy space. As I said before, they're engaged in active oversight of market participant positions, particularly in the front market, as I said, to cover convergence and orderly liquidation. Very importantly, it's not disruptive to current end-user hedging practices. And in this regard, Tom referred to Table 11A. I'd also like to refer to Table 11A, but particularly as it affects the spot month. Tom was looking at the any and all months. In the spot month, as you look at it, the number of people over the potential spec limit in the physical delivered commodity is extensive. Over 80 in natural gas, 40 and 30 in the other energy commodities. Those people have to be operating today under exchange-granted hedge exemptions. If we change the definition of what constitutes a bona fide hedge from what the exchanges are currently applying to the narrow definition in the proposed rule, all 80 of those people's hedging activities will be impacted. And 40 in the products and 30 in the others. So it's very, very important that we get this right to not disrupt active hedging practices. And the last point is that it provides flexibility for market innovation and evolution. A single list of enumerated hedges without the possibility of non-enumerated hedges eliminates the possibility that we'll be able to capture what's not practice is not engaged in now and not foreseen today. So all very important. There are really 3 steps in the way forward. The first is that we address the types of hedging that have been in comment letters and petitions over the last several years and revise the list of enumerated hedges to include those. We've had substantial dialogue on them. It has the additional benefit of narrowing the areas where we'd have not a need for non-enumerated hedges and have to rely on a different paradigm for that. So it's an important first step. The second is that we would request that the Commission consider advising that the positions and strategies that DCMs have currently employed in their rules be continued going forward. And we're not saying here that any specific practice should be, or any company's specific position should be recognized or grandfathered. What we're really saying here is that there should be a general endorsement of the types of practices referred to in exchange rules. And I'll just say, for example, CME Rule 559B talks specifically about anticipatory hedging and storage and some of the other things that we've talked about. So we'd be looking for a general endorsement from the Commission of that kind of activity as being appropriate for hedging exemptions. And that's important, too, because we need to look at the statutory framework. Both sections 4AC and 4AA7 are available for the Commission to do that, to acknowledge that those kinds of practices should be the subject of hedge exemptions. And finally, and the linchpin to a framework to rely on the exchanges is this. the Commission could, by rule or by statutory interpretation or order or exemption or whatever procedural vehicle it felt was appropriate, the Commission could state that in the event a DCM recognized a particular strategy as being a valid, non-enumerated hedge to be used as an exemption in their markets, that a party relying on that exemption could also take similar positions and strategies in the OTC markets and rely on a non-enumerated exemption for those positions as well. There would be a review process. I know somebody mentioned in the opening, I'm not quite sure who, that I guess it was Commissioner Giancarlo, that this would not mean that the process would not be subject to federal oversight. We'll get to that in a minute, but there absolutely would be a process for the Commission to consider whether or not the exchanges were appropriately exercising the authority that we would be delegating to them. The process would rely very much on existing process, and in that sense, that's really a benefit, I think, to both the market and to the regulators. An annual application would be made to the DCM identifying what a particular commercial entity's hedging needs were, what its business activities are, an application which, of course, could be supplemented if things changed. And just, I'm going to throw out some numbers. We can get back to an example and talk about it a little bit more specifically later, but I'm going to throw out some numbers just to give you a sense of what we're talking about. So in that application, for example, a commercial could show that they had expected exposure of 8,000 lots of futures equivalent, combination of a variety of different potential non-enumerated exemptions. What the exchange would do, and what it currently does, is it would analyze that application both in terms of whether or not the strategies claimed qualified for an exemption, but also whether or not the exposures seemed reasonable to the exchange. So an applicant might say, I did X last year, I've increased my staff, I expect to do 20% more than X. The markets are changing, I expect to do another 10% in some other area. The exchange scrutinizes that and they say, yeah, that's nice. We see what you've done in the past. We see what you expected to do in the future. We think you may be being a little bit optimistic. Instead of 8,000, we'll recognize that you have, for example, 6,000 lots of exposure in the coming year ahead. And then they consider what their market can actually bear. And in some contracts, there might be enough liquidity that they'd say, sure, you can have an exemption of 6,000 lots. In others, they might say, you know, there's not enough liquidity. We don't see enough experience on your part in this market, a variety of other considerations. And they might say, for our market, you can have a 4,000 lot exemption. And then they send you a letter and they describe what they've done, and they establish that limit as the limit on what you can do on their market. I will point out a couple of things here, not on the slide, but this comports very closely with Commission practice, both in existing practice in the ag markets, in the vacated rule, and in the proposed rule, in that, like a 704 filing, you have an advanced explanation of what the hedging practice is likely to be. You have an analysis of how robust both the strategy and the size of the positions are, and you have an actual limit established for the non-enumerated positions that would be taken. It also comports with Rule 1.48 that's currently used in the ag markets for non-enumerated hedges. The next step in the process would be new. And in that part of the process, for any non-enumerated hedge that was granted, the DCM or CEF would provide a notice to the Commission. And that notice would identify the non-enumerated hedge exemption that had been granted, giving the Commission an opportunity to review it and understand it. It would include the DCM's conclusion as to the size of the party's exposure, that 6,000 lots that I referred to before. And it would tell the Commission that it had granted the 4,000 lot exemption. An important note here, that notice, which would show a party's individual exposures, would have to be given complete confidentiality. Otherwise, it would expose the party substantially in the marketplace. So the outcome of all of this is that we'd have a paradigm for non-enumerated hedges where an exchange would set a limit for what could be done on its market, and it would also set a limit, i.e. its analysis of the exposure for what could be done across all markets. So that 6,000 number that I identified before, which would represent their view of a party's exposure, a party would be allowed to take that across DCM, CEF, and OTC markets, assuming, of course, that on no DCM or CEF that had given a specific limit, in this case the 4,000 that I referred to, could a party exceed that specific limit on that market. And again, we'll go back to an example at the end to just walk through that and make sure that it's clear to people. A very important part of this whole framework is certainty. Reliance on DCM determinations needs to have certainty to be effective for the marketplace. We've been debating these points for a long time. We need to put that to rest, either by getting them onto the list of enumerated hedges or relying on what the exchanges do and have done historically. And the review process that I mentioned earlier is this. If the commissioner or its staff doesn't agree that a particular non-enumerated hedging strategy qualifies, either when it gets one of those notices, during a rule enforcement review, or really at any other time, that treatment could only be changed prospectively and on full commission review, giving the public an opportunity to participate in the discussion on that. And whatever appropriate procedural vehicle the commission uses for that, I leave to those who know the APA better than I do. So there are a couple of things that aren't addressed in this approach. I'm not going to go into them now, but they're important. The economically appropriate test, which we discussed at the last EMAC, cross-commodity hedging, the so-called 5-day rule, and the reporting forms that are in the proposal, Form 204, which is currently in place, and some of the other new reporting requirements. These are all things that need to be addressed, but they're outside the framework that we're putting forward today. Again, I want to thank you for the opportunity to put this out there. We really hope it advances the ball. We've tried to address the Commission's regulatory interests and ensure that claimed exemptions are legitimate, while at the same time preserving hedging opportunities that reduce the costs of energy commodities to consumers. We look forward to answering any questions that you have and discussing this further over the next hour or so. Thank you.
Eric?
So I am going to, if I may, continue, follow Ron and give some context and furtherance of the presentation Ron's made from the exchange perspective. I think this is an interesting circumstance we have, because I think folks will recall a year ago, it was not CME Group and ICE were at a roundtable, and we put forward the notion that there was a possibility that we could be of some assistance in the process in a non-enumerated structure. We recently, were engaged to see if, in fact, what could we come up with. So we did have engagements not only with Ron but others, and Eric Haas and I, representing ICE, worked together, very much looking at it from the standpoint of what were not only the needs of the users, but what, from an exchange perspective, we thought made practical sense and was workable. And although many of the concepts where we've landed reflect exactly a landing point where we think we've intersected and we have a solution, there were certainly, there's an evolution that's occurred during this engagement. So what I'd like to do here, Eric and I are going to split up this part of the presentation. I just want to highlight very broadly some of the points. I'll call them cornerstone points. Ron's mentioned them. Turn to Eric, have him speak a little bit, to more broadly that existing exemption process that we engage today. Then I'd like to explore some of the real details from an exchange perspective on the non-enumerated process that we've conceptualized. So in terms of cornerstone points from an exchange perspective, these are, again, in furtherance of what Ron said earlier. We certainly would like to see the list of enumerated, recognized enumerated exemptions be expanded, whether it be through rule or order, but some structure that, in fact, the agency permissions the exchanges, I'll say DCMs, CEFs, in order to administer this non-enumerated process. And then lastly, some structure, and we've had discussions that's practical, that I think we can use the word here wholeheartedly. If the Commission does determine to administer and allow and delegate might be too strong a word, but allow the exchanges to administer this process, it has to be genuine. Allow us to make those decisions. We'll talk to you about our processes. When we make them, however, there is a process. We talked about some form of interpretive action process or other, whereby the Commission could come in after the fact, look at the decisions made by the DCMs, the CEFs, and say, you know what, on this one, we have an issue, and that in that process, I'll say involved parties have a right to explain what their perspectives are, how we got here, then ultimately the Commission would go forward some type of a formal public position on representing that outcome. So with that, those cornerstone points, I'm going to turn it over to Eric Haas at ICE and allow him to go through some of the processes in the exemption world.
Thank you. So as you consider this as a potential option, we wanted the commissioners and the committee to understand what has been referred to a few different times, the process really is. And so we're going to go through our existing exemption process. And with energy having expirations every calendar month, this is a monthly and very routine process for us. It starts out with an application being filed with the exchange by the applicant. They have to come to us and tell us the level they're requesting and what the underlying strategy is. They'll provide documentation supporting their exposure, as well as they have to give us their risk management policies and what their internal compliance and position limit monitoring procedures are. From that point, the Market Regulation Department at the exchanges reviews this. We'll first look at the justification that they've provided to support the level they're requesting. We'll review the underlying exposure, number one, to make sure it's appropriate, that it exists, that they have some documentation supporting that this is real exposure. We will determine whether the amount that they are requesting from a limit level lines up with their underlying exposure. If it doesn't, at that point, generally we'll go back to the applicant and explain that to them, that on our end, what we see is that the level you're requesting is greater than the exposure you provided. We can give them an opportunity to maybe submit more information if they've left something off, or make a determination that they don't get the level. Throughout this, there is a considerable amount of follow-up conversation in the review phase. We routinely go back to the applicant, ask for more information, get clarification on certain policies and procedures, and I think we've done a pretty good job with it since in Ron's presentation, the working group pretty much explained our exact process on his own. They're now very familiar with our interactions at both exchanges. After our review process, market regulation is going to make a determination. And as noted, we can approve the exemption, deny it, or conditionally approve it. And what conditionally approve usually means is if an applicant comes to us and asks for 50,000 lots and they have the justification for 50,000 lots, we might determine that that's not appropriate at the time for the market or for that participant. So a lot of times what we'll do is we'll say you can have 25,000 lots. If you get to 25,000 lots, you've already demonstrated that you have more exposure. Come back to us. We'll look at the market fundamentals. We'll look at your procedures. And at that time, we'll make a decision on potentially bumping you up. But what we're trying to avoid is giving anyone, commercial participant, the ability to just take their position up to the maximum of their exposure and to avoid any detriment to the market that might occur from that. So we're really trying to manage not only the exemption process, but how the positions are put on, and ultimately, if needed, how they're going to be taken off.
Eric, I have a question for you. What level of human and other resources do you have in place now to manage the exemption process, and what additional level of resources would you need if there was the delegation that you're talking about? And Tom, perhaps you at CME could also answer that question.
Currently, we have across ICE Futures US, I'm going to say there's probably 15, 20 people devoted to market surveillance. And in that market surveillance, that includes managing exemptions. And internally, we have really 3 different applications that are utilized to review exemptions. So it's an extensive process. Even working with, say, a commercial that we're very familiar with, and we have a good relationship with them, and it's an annual exemption, so each year they're going to generally come in and renew it. It's still a brand new process. And so the 3rd year, we're familiar, we know what they're doing, we know what their exposure is. It's still, I would say, a 5-day process for us to go through all the documentation, make our own documentation, make record of what we're doing and why. To expand it, it can be done. We'd have to see the extent of what comes in to make a determination if our existing staffing can handle it. Since Ben is here, I'm going to say it can't, and we'll have to definitely increase staffing, probably sooner. Thanks.
Sure. Commissioner Giancarlo, I would say that at the CME group across the asset classes, there's approximately 7 to 8 people that are looking at exemptions across the various asset classes. They're part of the market surveillance group, which is a much larger team in general, but 7 or 8 people. In terms of, I think we could certainly, handling the load, I think that one of the interesting points here we'll get to later is the OTC positions. I think that in terms of handling exemptions on our markets, I tend to think that we can probably kick this process off at current staffing levels. I can give you some context, and referring back to that time period I spoke about earlier with the impact analysis, we processed in the energy space 167 separate applications. And just to give the committee some context around the integrity around that process, and it's similar to what Eric had mentioned, these are not all just simply approved. A lot of these are considered reduced or denied. So of the 167, 114 of them were approved, but at less than requested levels based on either a host of constrictions that we viewed insofar as the market's ability to handle the position or some frailties with the underlying exposures. 49 were approved as applied for, and 4 were denied. Thank you.
Back to the determination process. After we make our determination, we are going to give in our approval letter the applicant the amount they've been granted. We note the spot month limit, what they can hold on top of it, and we're specific to what strategies they've been granted. So if at any time in the future they hold a position over the limit, they're aware of what their underlying strategies can be for that position. We don't want any confusion later on where they feel that they had an ability to use a different strategy and we're not on the same page. So again, our process with this is we're trying to be as clear as we can with the market participants so they know exactly where we stand, and we know that they know that. Adding to it, we don't give special consideration to commercial participants just because they're hedging, as Tom noted. You are a commercial participant, you have a hedging need, but we also have to manage our markets, and so we will cut them down at times on their requested level. And touching back on the accountability process, for our energy contracts, we do have accountability levels out to curve, And in doing those accountability reviews, we don't exclude commercial participants even though they have a spot month exemption. We'll still look at them out the curve, and if we feel that out the curve their position is too large or could be a problem, we're contacting them, letting them know, and can manage that process. So this isn't on the exchange side, it isn't a process where you're a commercial, you come in, tell us what you need, and you get it. We're managing our market. We're not treating them really any differently than any other market participant. And then finally, after we provide our approval, assuming it's an approval, we have an ongoing surveillance requirement. And even though the commercial participant has the exemption, we are following up with them in the future, reviewing their position, ensuring that if they are over the limit under the basis of an exemption, that their positions are tied to that exemption. And that, at any point, that exempted position isn't causing a problem in the market. So ultimately, the market price being not disruptive due to even a commercial is our biggest concern.
Can I just add a very quick point to that, and you can both correct me if I misstate this, and you retain the ability to revoke an exemption if market circumstances are such that that exempted size position would be a problem, in addition to jawboning authority to just convince a market participant to get out if it poses that kind of a potential.
Yes, to all. Yeah. So if I could, and thanks, let me continue with some further details about the process from the exchange perspective. As both Ron and Eric discussed, an application would have to be filed. And I'll note to the committee that, and the commissioners certainly, that I would envision that the applications, we process, as Eric said, these applications yearly or on an interim basis if needed. What I would envision is the parties that come to us on a yearly basis would take the applications that we have that would be modified as necessary, and not only include their enumerated exposures, but their non-enumerated exposures. In fact, some of that is on applications today. So again, I would tend to think in the same cycle, we would be integrating the totality of those requests. Again, nothing would stop someone from subsequently coming up with a new type of non-enumerated exposure and coming to us. But I'll note that in the first bullet, we want to certainly deal with the non-enumerated ones in advance of assuming the positions in the marketplace. So again, I do see this as somewhat of an extension of what we're already doing. So as Eric said, the DCM or the CEFs would approve or deny conditionally the exemption request, and we would assign a number on our respective markets. Could be, as I mentioned earlier, at the level requested, could be at less than the level requested, and there could practically be, and we'll go through an example later, a commingling, meaning that a party might come to us and say, I've got 5,000 contracts of enumerated exposure. I demonstrate 1,000 contracts of non-enumerated anticipatory merchandising, and additionally 1,000 contracts of non-enumerated storage hedges. Well, we encapsulize all that if we felt comfortable that the documentation was correct. We still might say that our exemption to you is 5,000 contracts, of which it can be basically populated by the enumerateds or some combination of enumerateds and 1,000 each of the two non-enumerateds, if that makes sense. So again, I could certainly see that kind of a circumstance where we're looking at the totality of the different types of exposures and denoting them. Mentioned by Ron earlier, in that letter, we would also do another very important thing that's not what we do today. In the letter that we would prepare to the participant, we would have had to done an analysis of that underlying exposure with regard to that non-enumerated hedge. And we will go through an example with numbers, but let's just say hypothetically that it was 5,000 contracts of anticipatory merchandising, where we only grant an exemption of 2. The letter is going to, in fact, contain both the numbers. The number that we granted, and just as a note, I'm focusing here, and I should state this up front, I'd like to talk in the context of a spot exemption to keep it simple. So we've granted an exemption of 2,000 because we were comfortable with that, but the exposure might be greater, might be 5,000. We're going to include that 5,000 in the letter that goes to the participant. Additionally, let me go to the next slide. We're going to forward collectively, between, whether it be Eric, myself, or any other DCM or SEF, those letters to the CFTC effectively by virtue of the fact that we're setting, through this granted authority in this new structure, an exemption for a non-enumerated hedge in our markets. We're effectively seeking to extend that to positions that might be held on an over-the-counter basis. And in that context, those over-the-counter positions would be bound by that larger number that we would be passing forward to the CFTC. The CFTC staff would then have the ability to, when looking at the totality of the positions, because I think a cornerstone point, I probably should have put on there, and if, maybe it was implicit to some, is that we're looking at positions in our market. We're happy to look at these exposures. I don't see, Eric doesn't see the OTC book on a regular basis. The commission does. So with regard to those OTC positions where the commission would be monitoring for, limit purposes, let us say in the spot month, we've got, limits in our markets, which we're monitoring. They certainly could be looking at that. They're also looking at, per the proposal, various positions in physical or financial buckets and across them, as well as the OTC. So there is clearly a role here that the commission has to have in terms of the ongoing surveillance of these markets, but we think we're passing forward, a valuable bit of information as it relates to each of these prospective non-enumerated exemptions. Additionally, all, again, not only approvals, but obviously all denials would be forwarded promptly to the CFTC. We've discussed the prospect and reality of conducting regular meetings, with an eye towards, we think it can only be beneficial for the entities that will be processing these to look at these in the same contextual way. Do we think that this makes sense so that, we're as unified as we can be in our thinking around this? And an outcome that wouldn't be great is that we're granting something and recognizing it and someone else isn't. So we'd like to think we could get further on the same page. We'd seek to then publish on each of our respective website a summary of the type of non-enumerated exemptions that we would have approved and coordinate to, I'll say, offer similar characterization. One of the fears is the infamous tomatoes and tomatoes. Someone says, I'm doing X. X to me is a little bit different than X to you. And there are likely those circumstances. So we would, again, in the context of our ongoing interaction to try and support this, we try to communicate regularly such that we're characterizing things that we would have done in a similar fashion. Consistent with what Ron had said earlier, the CFTC, through the rule enforcement review process or at any other time it deems necessary, can request from us any of the underlying materials and documentation supporting the approval or the denial. And last and certainly not least, it would be our view in this construct that if in fact we had this authority to grant this, did so, and subsequently through the process that I put forth earlier, the commission sought at some later date to review the materials and say, you know what, through some interpretive process, we don't agree that this particular non-enumerated hedge should be allowed, less some fraud or bad faith, which wouldn't happen. We have to have a safe harbor, as would the market participants, so that there wouldn't be a look back and say, you know what, the exchange made a decision, we don't like it. During this period, you were over the limits, and it's a position limit violation, and you're going to be sanctioned for it. So if we had that authority and administered this process, we'd both have a safe harbor. Less, of course, some ill act. I think that it would probably make some sense to, if we could put up that slide covering the example. I think while I spoke to it, it might be good to look at it on the board. So an application for a non-enumerated hedge exemption is put forward to both CME and ICE. That application, by the participant for whatever this strategy is, shows 8,000 futures equivalent lots of exposure. We conduct our analysis, and while we, broadly speaking, agree, we look at that exposure to be more like 6,000 futures equivalents. Based on the market liquidity and other considerations, we each granted 4,000 contracts. In that approval letter to the participant, we denote the recognition of the 6 in total. So effectively, that hedger may enter 6,000 lots of total positions on a combination of either CME, ICE, and the OTC, but bound additionally by the 4,000 that both ICE and CME group afforded. Anything else I miss? So,
Tom,
yeah.
What happens if one of you says, well, actually, I think you could have 8,000, but no more than 5,000 on either CME or ICE? Is the one who said the lower limit bound by the, or rather, is the one who says the higher limit bound by the one who says the lower limit?
The participant would be bound by the lower limit of the total exposure.
So if CME said, I disagree with ICE, I really think you could have 5,000, but ICE said, no, 4,000, CME is bound by the 4,000. Participants bound by the 4,000.
Let me maybe try and catch that. We're making independent decisions with regard to a number on our market. I thought, and I may have misunderstood, that what you were getting at was in like, say, this example, the participant showed to each of us, I have this OTC, this non-enumerated exposure of 8,000. I thought what you were getting at is, when I looked at it, I said, you know what? I really think that number is 4,000, and Eric, and that would be embodied in my letter, and Eric looked at that application and said, no, I really thought it's 6,000. In that example, we'd say that the participant would be bound to the lower determination, the 4. However, the process by which we communicate, we would hope to strike the same number on a regular basis. Much progress has been made.
What happens? Go ahead. Yeah.
I'm not sure, though, you answered the chairman's question. What if the same application goes to each of you for a product that is on both exchanges, which I have to think about that. But if you grant different levels, what is the market counterparty limited by?
Remember, each of us is effectively recognizing 2 things. A level on our markets. Mine might be more liquid. I grant a larger number on my market. His might be less liquid. So our decision for the number on our market is independent. They're independent. His might be larger, and he says, I can handle 5,000. I say, you know what? That's great. I can't. I can only give you 3,000. The parties has to respect the boundary that I set up on mine, also respect the boundary set up on his, It may be that we're in agreement on our analysis of the macro exposure that we pass on to the Commission, that then the party can hold in the aggregate across his exchange, my exchange, as well as the OTC.
So without digressing too much, maybe the broader thought is, as we go forward and examine this, whether there are any opportunities for arbitrage between the two exchanges that we need to think about. So the coordination, we need to think about whether for products that are fungible, whether there is perhaps some arbitrage opportunity, and if there is, it needs to be addressed in any final approach.
Okay.
Let me ask another question. I think, Tom and Eric, in your presentation, you talked about the exchanges publishing some facts about the exemptions you're granting.
Correct.
In Ron's presentation, he noted the need for confidentiality. We also have the issue of if the Commission reviews something, that would presumably be a public process. Can you talk a little bit about how quickly would you envision publishing something relative to the granting of an exemption? And how do we balance the issue of public entitlement to know, the concern Ron noted about the individual participants' desire for confidentiality, whether or not the Commission reviews it? But if the Commission then reviews it, don't all the facts become public?
Let me clarify and respond to your question from the exchange standpoint on the publishing. What we would intend to publish is by no means who received an exemption, but a characterization of the type of non-enumerated strategy that we each recognized. Again, trying to make those words as similar as possible to be consistent. And we would do so, I'll use the word promptly.
With amounts?
No. No amounts.
And then what happens? What happens if the Commission then reviews something?
I mean, I think that one's a little more for me because I talked about the confidentiality. I guess the hope would be that the Commission would be reviewing something as it would in a proposed rulemaking, talking about a strategy as opposed to a particular party's position or need. The problem, and I think it's a good point to focus on, is if, the unique strategy can be divined to be applicable to only one market participant, and I'm not exactly sure what you do in that circumstance, and it could present a conflict.
But I guess you're suggesting we would be publicizing the strategy but not the amount. And yet, presumably, the public's concern might be driven by the amount as well.
Well, I'm not sure about that, and I'm not sure,
Okay.
What the public interest is in analyzing that even under current structure. So the strategy for sure, if it's going to be something that has precedent and will be applicable to others, either if it's granted or denied in the future, clearly an interest in that. But currently, if somebody either and let's use the enumerated agriculture products that the Commission already has oversight from a position limit perspective on. If somebody takes a position in those markets, that's not up for public debate as to whether or not that's appropriate. And if somebody applies for a non-enumerated exemption, under existing process for those products, again, it's not open for public debate as to the size of the position that the Commission might grant if they granted one of those exemptions.
Let me just add to the expression of concern about the need for confidentiality. In the statute, when it talks about reporting, it attempts to guarantee that the identity of the entity reporting positions is kept confidential. But that's details of transactions that have already happened. In a sense, their history, yeah, there's some concern about getting front run as you try to hedge your hedge, but that's history. When we're talking about reviewing these applications for exemptions, we're not talking about history. We're talking about business we intend to do going forward. And the competitive value of that information is dramatically higher. Now, I don't have the legal answer to what all of the requirements are when you review material, but you are dealing with material that is of very high competitive value, even more valuable than the historical data on swaps that we have done, where the statute did explicitly protect the anonymity of the reporting party.
Tyson?
Thank you very much. So I'm Tyson Slocum. For those unfamiliar with my organization, it's Public Citizen. We're a public interest nonprofit consumer advocacy group. So before us, we appear to have a fairly significant proposal that would, in essence, delegate some Dodd-Frank functions to the private for-profit exchanges instead of having these activities done by the commission. So that's my understanding of what this proposal. No, that isn't what this proposal is?
I think right now what we're saying is this version is not a delegation of really anything to the exchanges. It's allowing us to continue to do our current process, and the CFTC passing some rule allowing the person who receives an exchange exemption to utilize that for an exchange exemption for non-enumerated hedging, to potentially use that for OTC. The CFTC would still have the responsibility to monitor for that and manage that. All they're doing is allowing us to continue our existing exemption approval process. It's not. I wouldn't classify it as a delegation to us.
But it is serving a function of within the position limit regime that rather than have CFTC conduct a review of an exemption, that would be instead handled by the market surveillance staff of the exchanges. Is this accurate?
I'd say initially that would be the case with the, as we've, again, conceptualized, the ability certainly for the commission to come in and modify, revocate. But, Tyson, again, remind you, and I think that the numbers are probably similar for Eric. I guess when you mentioned, for-profit, way more than double the amount of exemptions that are processed by the exchange are tuned down or denied. So we're bound. We're getting rule reviewed. This isn't about taking on a process to expand our business model. In fact, we're exempting here positions on our market, but practically speaking, we're setting a boundary of positions that can be held outside of our market in the OTC space. So I just want to be clear. I don't see, I think, the point you may be poking at with the for-profit exchange. You've got the regulators here have got a clear responsibility that are getting rule enforcement reviewed on a regular basis who are owed to maintaining certain standards in that decision-making process. And additionally, you've got the agency clear oversight and an ability to revocate or evacuate as they see appropriate.
So just to understand, I mean, the exchanges earn money through fees on trading volume. So the greater the trader volume, the greater the fees that you can collect, through selling proprietary data and then selling preferential access through co-location services and things like that. So the question I have is, how exactly is the independence of the market surveillance offices maintained within your corporations? I didn't see a real explanation of that in your presentations.
Sure.
I mean, are there firewalls? What are the...
Absolutely. So I'll speak about my institution and certainly let Eric speak to his. There's absolute independence. There are, number one, there are proprietary systems. There are risk disclosures, the market surveillance. and just market regulation team in my institution doesn't share public space with other areas of the company. Strict confidentiality standards, yearly disclosures. There is an absolute firewall as to who gets access to data that is regulatory in nature. Absolutely, positively, unequivocally.
How is that firewall enforced? What third party oversees that? Is this an internal enforcement, or is there an outside third party that enforces that absolute firewall?
It not only is internal, but we have, and I forget that, Brian will tell me that in internal, not internal affairs, what's our global assurance?
Yeah, internal audits.
Internal audits, conducts reviews of, in fact, the independence and the integrity of that relationship.
So just to be clear, that's an internal enforcement? What is this, a third-party entity?
Internal.
So it's an internal enforcement of a firewall. I'm not.
And of course, the CFTC conducts rule enforcement reviews that look at it, again, how we're structured, where we sit, and I'm quite confident if the agency felt that there was some ill with regard to how our confidentiality structures, were constructed, they'd be more than happy to make those very public.
And actually, I think we have a number of other questioners here, so if there's time, we can come back to this, but I'd like to recognize Ben.
Thanks, Michael. One other thing I'd add to that is, as president of ICE Futures US, that our regulatory function and compliance function doesn't even report directly to me. It actually reports to what's our regulatory oversight committee, which is an independent set of board directors that oversee that group. So I have no reach directly into that group or visibility into some of the concerns that you would have in being able to direct and say, grant an exemption for this person for XYZ commercial reason.
Todd? Todd Creek with ICAP Energy. We serve as an intermediary in the futures market as well as the OTC swaps market. So we have a very holistic view of the marketplace. What I would like to say is that just with what's been implemented so far, we've definitely seen a decrease in volume, a decrease in the number of participants, and definitely a decrease or a widening of the bid-ask spread out the curve. So we're very concerned of what this might do. Obviously, if we implement these position limits very uniformly without giving, control to, I should say, having guidance from the exchanges who know these markets very intimately. So one point I would like to make, I know that that a lot of the markets have converted from swaps to futures, so we have to think about the headroom necessary to accommodate these participants as they make the conversion to futures. And I know that Commissioner Weegan made a comment about the ag market, specifically saying how well it had functioned. What I might note, and I'll ask Tom just to confirm this, it's my understanding that in ags, actually the position limits were doubled in ags, I believe, in 2012, specifically corn, for example. So, it doesn't mean that that a market can't function just because you increase the position limits. I think it's been a success. I don't know if you have any comment on that.
I think that, and I don't remember the exact numbers, we did up the position limit. It hadn't been updated in many years. Some of that got hung up, frankly, with the various rulemaking proposals. But yeah, I know we increased the limit, I believe, in corn, Todd.
And just one more comment, too, I'd like to make. We are concerned about heat rates. I know Ron said that we were not going to address the cross-commodity hedges as part of this. But I would like to note that in our business, we see that heat rates are an integral part of the trading communities today. And in fact, we should take a look at what percentage that represents, because clearly we're bringing natural gas into the fold here under this. And unless we exempt that, I think will materially impact the utilities. And I see it every single day. This is how a large majority of the electricity contracts or the utilities hedge today via heat rates, and it should be addressed. I know that a number of the comment letters have spoken to it, but I've yet to see any type of it's specifically addressed in any type of enumerated hedge. So.
Hi. Thank you. Lopa Parikh with the Edison Electric Institute. Today in our comment letters, we hadn't really discussed this proposal of delegating to the exchanges. Since that time, we've been talking about it amongst our membership quite a bit, and we're very supportive of the proposal and many of the concepts that have been discussed today by the Commercial Working Group and the exchanges, especially for energy commodities as our members are trying to work through the rule and the implications. Some of the record keeping and the regulatory burdens that are associated with the current enumerated hedge proposal, they find to be very troublesome. They normally fall into three primary categories. The first one would be, classifying each individual transaction to try to figure out which bucket of enumerated hedge they fall into, and possibly developing new systems to track these. There's also some conversion issues, and also issues with the forms itself, because the OTC and power products don't necessarily fit neatly into any of the fields. And so because of that, expanding on the successful exchange process that was just discussed today is very attractive to a lot of our members. And so we would encourage the Commission to continue the discussion on how that would work, and possibly delegating more to the exchanges rather than having enumerated hedges. In terms of OTCs, we're also comfortable, many of our members use OTCs and don't use exchanges at all. And so in discussing that with our members, they're comfortable with, having some percentage of managing some percentage of their OTC contracts to the exchange limits, and then notifying the Commission, when they would go above that threshold. And so that would, kind of provide the Commission with transparency into the process, but still allow our membership to continuing the hedging that they currently do in order to meet their customers' needs. And so, and we've outlined a full process, which I'm happy to discuss in more detail, which is very similar to what the Commercial Working Group has put forth. I think it maybe expands on that process a little bit. But I just wanted to express some of our concerns with the proposed rule in terms of the burdens that it places on our members, and why this delegation proposal is attractive to us for that reason.
Thanks, Mike. I guess a quick process question. I think the chairman answered this, but just to be sure, this concept obviously would be something that would be reproposed and put out for public comment?
Well, I'll defer ultimately to our lawyers and other staff, but my own view would be that if we were to go down this road, it's important to make sure we have a process where the public can comment. And so I would envision, I would support at least, doing it in a way when on this aspect of the rule, we take further comment.
Well, and thank you. And just a quick comment on that. Commissioner Giancarlo earlier referenced farmers and ranchers and concerns over the drop in commodity prices. Independent producers of oil are also aware of a drop in commodity prices, and therefore sensitive to limitations on hedging strategies and other limitations on liquidity. And recognizing, as Commissioner Bowen said, this rule has been out there. I also think that folks, this committee seems to be moving more towards the concept of how to implement position limits, rather than the old argument of whether position limits are in fact needed. And therefore, to me, it's still within the spirit of the congressional intent, these types of concepts being proposed. I would not view it as sort of a delay on it, but rather this is really in the forward momentum to getting towards a regime that is workable for the community. And, I think you may get groans if if certain segments are reproposed. But in the long term, I think that the discussion and the viewpoints are such that there seems to be some still problems to be worked out. And if we can engage the expertise of the exchanges to make this work better, then that ought to be a prudent course, and taking a little grief on another proposal, it may be worth it.
Tom, did you want to respond to any of these comments?
Mike, I want to just follow up on a point that Lopa made, because she reminded me of something critical that I neglected to mention. We spoke especially me in terms of the process, spoke about the applicants coming to the exchange, applicants that maintained positions on our exchange or transacted, cleared with us. What I didn't address was what might be processing of a request for a non-enumerated by someone that doesn't touch one of us. And I put it out to this group that we're willing to, and we've had some discussions to talk about how we could do that. Frankly, one of the issues is, and it goes back to the resource issue, I don't know how big it is. I think we'd have to have some type of a dialogue with the commission based upon the data that they're in possession of to get some kind of context of what that looks like. Because I just don't know. I don't know if there are 2 people or there are 63 people that that we don't deal with today that would be wanting to come to us, and it goes to how do we potentially support and resource that. So I think we're open-minded to want to dialogue around that further and prospectively entertain that, but we need some more information, and so we'd be anxious to speak with you.
Jim?
Question for Tom, going back to your impact presentation, so back to the beginning of the morning.
Yeah.
So if I understood you correctly, you talked about your targeted concentration limits on the accountability tests, and you said something like the further out you go on the curve, the greater your tolerance for concentration. Is it reasonable to conclude from that the threat of excessive speculation is less outside the spot month than within the spot month, and in fact that threat declines the farther out the position is?
I think that, Jim, that would be our position. Though I'm not going to say and dismiss it completely, but as you go further out the curve, that it's more difficult. And I'm not saying that someone couldn't have substantial positions across the entire curve and become a concern for us, but outliers in various months basically pose less of a concern for us. And again, where we see those, assuming that they're through our thresholds, we're addressing them.
Dina?
Dina Wiggins with the Natural Gas Supply Association, and I just wanted to comment that we have, in past comments filed here at the Commission, supported a greater role for the exchanges and very much appreciate the work that ICE and CME and Ron's working group have put into this proposal. Looking forward to continuing to work within this process here at the Commission to address some of the details that have been brought up about, as I think Jim appropriately pointed out, confidentiality is a huge concern of keeping the details of these transactions or these proposed transactions confidential, but very much look forward to continuing to work on this because we think it's a good idea to have the exchanges involved in this.
Vince?
Vincent Johnson, VP. Tom, I had a quick question, a process question to follow up with you around the process. So if what you said, I think you were making statements around having for non-enumerated hedging, the ability to make the decisions and then CFTC to look at that. But if BP comes and you get approval for a non-enumerated hedge exemption, I don't know, 3 months later, we are taking on risks, we're hedging, setting about a new business practice. And then the commission, 6 months later, if the commission comes, and the commission, not because of bad data, but because of a difference in interpretations, and they disagree, I'm just wondering how that works. So if we set up a process relying on what you approved, how would that work in your thought?
My thought would be that if the commission, through that process, ultimately determined that that strategy was not allowable, we'd have to set up some kind of a structure to talk about how to, again, if they're in excess, if that in its totality is in excess of a would-be limit, talk about some type of an orderly liquidation, or realize that those positions would have to be warehoused within the allowable spec limit. So if it was, again, so if you were over with regard to that strategy, yeah, there is an impact point where I think we'd have to talk about an orderly liquidation. Not so dissimilar, frankly, from the point that Ron touched on. Market circumstances change, markets change, someone put on positions. There's a significant contraction in the open interest profile. We're concerned about the concentration. We talk with folks about how to, in an orderly fashion, we're not looking to harm people, but we've got to get to a certain point. So yeah, we think we'd have to work through that, Vincent.
Russ?
Russ Wasson with the National Rural Electric Cooperative Association. We filed a comment letter, and it's our position that entities that don't speculate that should be granted exemption under 4AA7. The Commission should use their jurisdiction to grant that exemption. And the reason is because of exactly what Lopa mentioned when she talked about cost. Costs are absolutely critical to our members. And I don't know how many of you saw the New York Times article that came out late last night, which said that the president's climate plan, the final rule may come out on Monday. But in conjunction with looking forward to that, which is probably going to increase the cost to everyone in this room to some degree or another, we conducted a comprehensive econometric study of rural America and the 42 million people we serve in rural America. And we determined that a 10% increase in the price of electricity, which to us doesn't seem like that much, to our members would result in the loss of 500,000 jobs in rural America, but it would take us 20 years, given current growth rates in rural America, to recoup the economic benefits of those 500,000 jobs that were lost. So we have approximately 5.5 million people out of those 42 million that I mentioned whose annual income is $25,000 or less. So to them, a 10% increase in the price of electricity is not a problem, it's a tragedy, because they have to make a decision about what are they going to do. Are they going to spend that money on food or medicine? Are they going to pay their power bill? And so if we are going to use a position limits rule to regulate the hedging of commercial end users who are hedging their ongoing operational risk and forcing us to go get the thousands and thousands of hedges we do along those lines enumerated and exempted, that's going to substantially increase our cost of operations. And on top of everything else going on, it's going to put a great deal of pressure in the countryside and rural America where our members provide power.
Paul Hughes with Southern Company. I don't want to get us off track, but I do want to maybe make a couple of points and see what you guys think about this. We have been talking about position limits, and my assumption is that everybody is assuming that when we talk about limits and we talk about positions, that would not include anything that would be intended to be physically settled or to be a trade option. I realize we have a panel later this afternoon, and I'm not trying to jump ahead. But when you ask a question, you said, yeah, I'm just not really sure how big that OTC market is. Depending on how we answer that question of what is in the population, if it includes contracts that are intended to be physically settled, it's a very different answer. And so that's a little bit of a statement. I guess my question would be, in all of our discussions so far, are we kind of stating, hey, we're making an assumption that those contracts would not be included in the analysis we've been talking about?
I don't think we're considering what happens with trade options and a bunch of those becoming swaps. We're not. We're thinking right now just what would be out there as defined as your swap business. Your swap business.
And from the physical bucket, if you will, we were thinking that those trade options would look more like forwards.
And that's what our comment letter has suggested as well.
Okay. I know there may be another question or two. We've run, I think, very, very thoroughly and well through this topic. I'd love to thank our panelists and everyone for questioning. We're going to take a 15-minute break now and start again at 12 o'clock.
Perhaps we should relocate our seats to get started again.
Okay, we'd like to begin. If everyone would take their seats, please. Okay, welcome back, everyone. Our second panel will be discussing a phased approach to position limits. I'm going to let each of you introduce yourselves briefly and then begin, and we're very interested to hear what you have to say.
Okay, to YJ Bourgeois with Anadarko Petroleum on behalf of NGSA today.
Bill McCoy, I'm here representing the Futures Industry Association.
Stephen Berger from Citadel. I'm here on behalf of the Managed Funds Association.
Okay, I think I've been asked to lead this discussion off. And first of all, on behalf of Anadarko and NGSA, I wanted to thank CFTC and the EMAC Advisory Committee for this opportunity to present an end user's perspective on position limits, especially relative to natural gas. As the CFTC considers rulemaking in regards to exchange-traded position limits, it may be useful to consider how a typical end user navigates these limits currently and impacts our business operation. Anadarko is one of the world's largest independent producers with approximately 2.9 billion barrels of oil reserves and proved as of December 2014 and 2014 sale volumes of 2.6 BCF a day of natural gas and over 400,000 barrels a day of oil and NGLs. We have an asset portfolio that's diversified with U.S. onshore plays, deep water Gulf of Mexico, and exploration and producing activities worldwide, including places like Mozambique, Algeria, Ghana, and Brazil. The company's most significant market risk relates to prices for natural gas, oil, and NGLs. As energy prices decline or rise significantly, revenues and cash flows are likewise affected. As such, the company does actively use derivative instruments to reduce the price risks associated with future production, as well as to manage midstream and marketing activities derived from various processing, transportation, storage, and purchases and sales arrangements. There are a number of broad issues discussed today with the current position limit rule that are of concern to Anadarko, including accurate deliverable supply determination, limits being set at artificially low levels, and the relative inflexibility and narrow scope of enumerated bona fide hedge categories. But today, we will focus our comments on the spot month issues. More specifically, the first step of the path forward is the need to focus on appropriate spot month limits to ensure the continuance of sufficient market liquidity, which is critical to price discovery and the orderly convergence of spot month futures and cash prices. Via the exchanges, we currently have a robust oversight process, as you heard about earlier, designed to ensure an efficiently functioning market. We further suggest the energy markets are currently achieving a highly effective price discovery process and believe any position limit changes by the FTC should look to maintain, if not foster, energy markets. This efficiency can be seen in how readily the physical and financial markets converge each month. Importantly, this convergence dynamic held true during the struggling 2008 financial crisis, where in the midst of a sharp run-up in natural gas prices and a quick ensuing dramatic price decline, the natural gas, all while the financial system was in disarray, natural gas market continued to converge tightly with the physical market. Not only is this a compelling argument as to how well the price discovery process functions, but also supports why the current focus should be on the spot month issues, as outer months do not undergo the same crucial cash to futures convergence process. This market efficiency and integrity should absolutely be preserved as any new regulations are implemented. As noted in previous NGSA comments, the initial focus of the Commission should be centered on the spot month physically settled futures contract, where the greatest potential for market manipulation, if any, naturally resides due to the physical delivery mechanism. Financially settled contracts have historically posed very little potential for manipulation and should therefore have the benefit of much higher limits. To this end, we suggest the following. An accurate determination of deliverable supply to determine the appropriate level of spot month limits for physical futures. Our view is consistent with NGSA in that position limits be closely aligned with physical deliverability. The methodology currently put forth by CME, utilizing physical receipt and delivery capacities, including backhaul capacity at Henry Hub, suggests upwards of 5.7 BCF a day of deliverable capacity exists. Taking 25% of the capacity, as proposed in the current regulations, would equate to roughly 4,245 contracts as a spot month limit, far above the existing 1,000 contract spot limit, which represents only 6% of the current Henry Hub capacity. With respect to spot month limits on financially settled contracts, although we agree with having limits on physically settled futures that are correlated to physical deliverability, spot month limits on financial settled futures, if any at all, should be based more on a percentage of open interest. In other words, establish financially settled limits as a function of the financial demand, as reflected by open interest, rather than an artificial threshold. Also, limits for financially settled contracts should not be contingent on having a zero position in physical futures, which would unnecessarily drain liquidity from the physical futures market. In addition, this would support larger size positions to be held in the financially settled contracts as opposed to physical settled contracts, posing much less potential for price manipulation via short squeezes and or market cornering. And thirdly, we support the Commission utilizing a phased-in approach for implementing opposition limits. We believe the initial effort should concentrate on the spot month issues, as we and others are discussing today, to help foster market liquidity and healthy function. A measured, phased-in approach will afford the Commission the valuable opportunity to evaluate and assess the effects of new regulation over time to guard against potential ill effects or unintentional consequences in the critical spot month. Further to this point, it is our view today that the exchanges do an excellent job for monitoring and administering limits to assure orderly market participation. The exchanges today already require conformance to non-spot month limits utilizing outer month accountability levels that you heard discussed in the prior panel. This role could conveniently continue as any new spot month regulations are implemented to provide the Commission the time needed to allow for a phased-in approach. After the successful implementation of the initial phase, a second phase can be initiated to address non-spot month limits and associated issues with the benefit of information gained in the initial phase. In closing, it is extremely important for Anadarko to continue to utilize financial markets to hedge its commodity price risks. It is imperative that we maintain the ability to execute hedging programs as needed, and the essential keys to this are healthy, liquid, transparent, and fully functional marketplace. The potential inability or difficulty to execute our hedging programs due to restrictive position limits, burdensome regulations, or cumbersome restrictions pose a serious financial concern to Anadarko and our shareholders. We urge the Commission to consider these issues and, along with industry input and participation, achieve a regulatory framework that has appropriate oversight while allowing for a liquid and efficient market. We firmly believe both can be achieved.
Morning. Thank you for asking FIA to participate in today's meeting, and in particular for the opportunity to comment on a phased approach to position limits. We support the Commission's efforts to foster competitive and efficient markets and believe this forum will help accomplish this goal. Broadly speaking, we remain concerned that the proposed position limits may disrupt markets and ultimately do more harm than good. As set forth in our prior comment letters, we hope the Commission will reliably assess whether the proposed limits are in fact necessary before imposing new limits. In our view, the assessment should be based on quantitative data that empirically supports the adoption of new limits. Only then can we be sure that we're not putting the cart before the horse, so to speak, imposing significant costs and barriers on market participants without discernible benefits. If, however, the Commission decides to move forward with the proposed limits, FIA recommends adopting the limits in phases, starting with the spot month limits, and then addressing non-spot month limits as necessary and appropriate in a separate rulemaking. A phased-in approach would have a number of significant benefits, including, first, allowing market participants time to comply with the applicable limits. Second, focusing the regulatory efforts on the spot month, where the markets are most active. And third, permitting the Commission time to consider and modify the position limits regime as it develops and takes shape. The FIA recommends that the first phase be limited to spot month position limits for the 28 core reference futures contracts. Most of the proposed core reference futures contracts already have a CFTC or exchange set spot month position limit. And as a result, market participants have some experience monitoring futures contracts towards a spot month speculative position limit. FIA expects significant implementation issues among our members that necessitate a transition period to come into compliance with new federal spot month position limits. For example, the current set limits, the current exchange set limits only apply to futures contracts. Market participants will need significant time to develop systems to incorporate swaps positions toward a speculative position limit. In addition, the CFTC administers speculative position limits differently than the exchanges. For existing CFTC set position limits on agricultural futures contracts, the CFTC imposes regular reporting requirements for bona fide hedging positions, whereby market participants file monthly reports to the CFTC, identifying cash market positions that serve as a basis for bona fide hedging positions. The CFTC's proposed position limits for futures and swaps in energy, metals, and agricultural commodities includes reporting requirements similar to the existing CFTC rules. In contrast, the exchanges typically do not require the submission of monthly reports. Rather, as we heard somewhat this morning, a market participant applies to the exchange for a hedge exemption. In some cases, the exchange, in its discretion, may grant that for up to a year, though as we heard, the exchange may revisit it throughout the course of that year. But market participants will need time to get accustomed to the monthly reporting regime under the federal administrative structure. After the Commission adopts and gains experience implementing federal spot position limits as part of the first phase, the Commission should reconsider position limits outside the spot month, and specifically whether they're necessary. The Commission should address non-spot month positions as part of a later and separate rulemaking proposal, which obviously will have the benefit of additional comment as various market participants gain experience with the implementation of the first phase. As FIA has commented in the past, and both CME and ICE described at the last EMAC meeting in February, liquidity for energy products generally decreases further out in the curve. Because of the limited liquidity available in deferred months, the Commission should take particular care first to find that position limits outside the spot month are necessary and that the levels of any limits are appropriate. In determining whether levels are appropriate, it is important that the Commission use and consider open interest data that is both comprehensive and accurate with respect to both futures and swaps. The Commission should evaluate all the relevant and current open interest data for each reference contract and should further rely on the OTC swap data reported to the SDRs and swap data reported directly to the Commission under Part 20. If the Commission uses open interest data that is too narrow or inaccurate in setting the limits, it runs the very real risk of unduly restricting liquidity for bona fide hedgers or negatively impacting the price discovery function. Now, this phased approach offers a variety of benefits to both market participants and to the Commission. For example, after the Commission adopts spot month position limits as part of Phase 1, the Commission could focus its limited resources on the administration of spot month limits. As the Chairman has made clear previously, the CFTC is currently underfunded, so it should focus its resources on the spot month position limits, where large positions present potentially a greater threat of excessive speculation or even the risk of manipulation than do positions further out in the curve. The Commission staff could continue to collect the data and analyze the data regarding futures and swaps positions further out in the curve in order to determine whether position limits are necessary and whether any proposed position limits are appropriate. The initial phase for spot month position limits could provide market participants time to adjust to the new position limit regime for the most liquid part of the curve, the spot month. In addition, the Commission staff could evaluate its definition of bona fide hedging for purposes of the spot month limits and make appropriate adjustments if the Commission determines to impose non-spot month limits. In short, a phased approach would allow the Commission to calibrate the hedge exemptions as the position limits regime develops. As FIA has commented in the past, the Commission's proposed definition of bona fide hedging is overly narrow and may further decrease liquidity outside the spot month. If a hedge's positions are classified as speculative, its activity is now subject to a cap that reduces liquidity. Further, if a hedger's position does not qualify as a bona fide hedging position, a dealer in the OTC markets may be less willing to provide liquidity to the hedger because the dealer cannot rely on the pass-through swap exemption to hedge its swap position with the hedger. Because liquidity is already limited out the curve, the Commission should ensure that it establishes an appropriate definition of bona fide hedging positions. Otherwise, the Commission risks unnecessarily limiting liquidity for bona fide hedgers outside the curve. If the Commission expands the list of enumerated hedges and adopts an efficient process to recognize non-enumerated hedges for purposes of the spot month limits in Phase 1, the Commission could further expand the definition before it proposes any non-spot month position limits in a second phase. Now, as part of this phased approach, the Commission should evaluate the use of position accountability levels outside the spot month as opposed to hard limits. In connection with the last EMAC meeting, FIA submitted a comment letter explaining that position accountability levels do represent a form of position limits and that the Commission has the authority to impose position accountability levels outside of the spot month. So after imposing spot month limits in the first phase, the Commission could evaluate the appropriateness of accountability levels instead of hard limits outside the spot month. In addition, to conserve Commission resources, the Commission could evaluate and propose an appropriate framework to employ the administration of accountability levels at exchange levels. Finally, I'd like to talk about the authority of the Commission to adopt a phased approach as between the spot month and the non-spot month position limits. As Commissioner Giancarlo noted in his opening remarks, phased approach has been used by the CFTC before in implementing clearing. I believe also phased approaches have been used in the context of reporting and CEF trading. Also in its prior rulemaking with respect to position limits, that's in CFTC Regulation 151, the Commission explained that it had the discretion to phase in position limits for all physical commodity futures contracts and economically equivalent swaps, but chose appropriately to start with the 28 core reference futures contracts. Because the Commission has discretion in its rulemaking to phase in various types of rulemaking, the Commission has this discretion to phase in spot month and then non-spot month position limits. In addition, the Commission can rely on its exemptive authority in Commodity Exchange Act Section 4A.A.7 to exempt non-spot month positions from speculative position limits during Phase 1, and thereafter determine whether to establish position limits outside of the spot month. So on behalf of FIA, again, I'd like to thank the Commission for allowing us to provide these opening remarks and entertain any questions.
On behalf of MFA, I'd also like to thank the Commission for hosting today's meeting and thank the committee for providing us with the opportunity to address you all today. For those of you who aren't familiar, MFA represents the global alternative investment industry, including hedge funds, managed futures firms, and their investors, by advocating for sound industry practices and public policies that foster efficient, transparent, and fair capital markets. MFA members help pension plans, university endowments, charitable organizations, qualified individuals, and other institutional investors to diversify investments, manage risk, and generate attractive returns. As investors in the commodity markets, MFA members play an essential and beneficial role. The research and analysis that we provide and express in the marketplace leads to greater transparency, more efficient economic decision-making by producers and consumers as a result, and we believe it helps optimize resource allocation in the real economy. The market activity of MFA members enhances liquidity and facilitates the price discovery process. We believe this helps normalize prices of commodity futures at different maturities and dampens price volatility. These market efficiencies help producers and consumers with their risk management needs and help inform forward capital investment and resource allocation decisions. The ability of investor capital to take long and short positions and bring new information to the marketplace helps foster deep, liquid, efficient commodity futures markets. Limiting legitimate activity undermines all these benefits. MFA believes that any rulemaking on position limits should be empirically driven and not based on partial analyses. Further, we are concerned by a one-size-fits-all approach and have specific concerns in the context of the energy markets that using an approach that's worked for the legacy agricultural contracts may not at all be appropriate for our energy markets. We don't believe there's been an adequate necessity finding yet established with respect to establishing position limits, but want to present nonetheless here today our proposal for how to phase in any position limits if the Commission does go ahead and go down that path.
Stephen, can you just get a little closer to the mic, please?
Sure, no problem. In short, we believe, and I think it mirrors closely what you've heard from my fellow panelists, that the CFTC should adopt position limits and position accountability measures through a two-phase rulemaking approach. Phase one of that approach would focus on adopting spot month position limits. Of course, I think with the corrections that YJ importantly noted still need to be made to that proposed regime. That process could also involve finalizing the Commission's approach and definition with respect to bona fide hedging transactions. And during that first phase, would provide the opportunity to rely on and review data from the exchange position accountability regime for the non-spot months. Then in phase 2, a separate rulemaking could be undertaken to adopt positional accountability levels for non-spot months based on the further informed data that's gathered during phase 1. I think we believe that the key benefits of a two-phase rulemaking approach is that it would provide the CFTC with more time to gather accurate data and reliable data. It would also minimize unintended consequences, decrease the risk of market disruption, and afford the Commission, again, better data on which to base non-spot month position accountability levels. We believe that the position accountability regime for the non-spot months would strike a better balance between ensuring effective oversight of the markets while also preserving liquidity and the efficiency of the price discovery process. We think that the position accountability regime, as I think earlier panelists have mentioned, does have teeth. There is the ability to put limits on market participants from further increasing their positions or call on market participants to reduce their positions as necessary, and I think, again, the exchanges have already outlined this well. We believe that the two-phase approach that we've proposed would address a number of concerns that MFA has outlined. The first, again, being that the CFTC's proposed limits are based on incomplete data. We believe, I think as everyone in this room does, that position limits should be based on accurate and up-to-date data, both on deliverable supply with respect to the spot month and open interest across both futures and swaps with respect to any non-spot month limits. But having that full data set is going to take time to further gather, and in addition, until the bona fide hedging definition and approach is finalized, the classification going forward of what's going to be hedging versus speculative activity, breaking that data set down won't happen. We believe that the approach would also address our concern that the proposed position limits are miscalibrated and have been set too low. I was particularly intrigued by the presentation in the first panel from Tom LaSalle of CME, because I think he gave a much more granular investigation of the data that the Commission put forward in Table 11A of the February 2015 release. When we at MFA looked at that table, we were very concerned about the number of participants that it identified as already being near, at, or above the proposed limits. And we don't believe that, we think that's indicative of the fact that the proposed limits would restrict legitimate market activity. We don't believe that the CFTC has found or made a finding that there's excessive speculation at the limits that are proposed. So that leads us to conclude that either the data is incomplete or that the methodology is wrong, or perhaps both. So position accountability would certainly provide a much better regime and a much more flexible regime to investigate why there are so many people at or above the limits that have been proposed, and what's driving that, and how that can be addressed. I wanted to take a minute to just look at again, I think one of the points we made up front was that the one-size-fits-all approach may not be appropriate across different commodity markets. And so when we look at the proposed limits that have been put forward for certain of the energy contracts in the non-spot month, we see a proposed non-spot month limit for crude of 109,000 contracts, but for gasoline, 11,800 contracts. And then we look at that in comparison to what the actual demand in the marketplace is for those two commodities. And you see for crude in the U.S., it's about 16 million barrels per day, while for gasoline, it's about 9 million barrels per day. So the discrepancy that struck us in that context is that you have a limit for crude that is 10 times that of gasoline, but actual real demand in the marketplace for the product, there's a 2-to-1 differential. So there appears, in our view, to be a massive or a significant miscalibration of where the proposed limits are versus the actual underlying supply and demand fundamentals in the marketplace. Further, the energy markets are undergoing a period of dramatic change. Over the last 5 years, particularly U.S. exports of distillate and gasoline have grown significantly to nearly 2 million barrels a day. We believe that results in an increased demand for refiners to hedge distillate and gasoline production, and that disproportionately low limits for those contracts is going to impair the liquidity and the ability of that market to function. So I think that points further to the fact that a one-size-fits-all approach is not going to be effective, and that we need to take a two-phase approach to calibrate things appropriately for the non-spot month limits and to understand what approaches are appropriate for different types of commodity markets. In particular, again, just importing a methodology that has been in place for the legacy agricultural contracts may not at all be appropriate for the energy markets. In MFA's view, the energy markets are more global. The products in them are more fungible. The overall supply is significantly larger. There's much less seasonality in terms of production, and the energy markets are much more subject to macro developments that affect prices and liquidity in the markets. In addition, the nature, I think, as others have pointed out already, in terms of where open interest is concentrated, whether it's just in the first few months out, which tends to be typical in the agricultural markets, versus up to 60 months out in the energy markets. So the nature of where open interest is and how it's distributed along the curve is significantly different in the two markets. One last point I wanted to make in closing relates to whether there's the appropriate authority to pursue a phased approach, and MFA believes that there clearly is. Both the CEA and the Dodd-Frank Act, reference that the commission may impose limits as appropriate, and that also there's a requirement for a necessity finding to be done. So if it's inappropriate to impose hard position limits outside of the spot month, or there's not a necessity finding that that's necessary, it seems pretty clear cut that more tailored approaches could be taken to phasing in position limits. Again, thanks for providing MFA the opportunity to address the committee today. Thank you.
I'm going to, I have a couple of questions I'd like to start with, and then anyone else has a question, please put your name up like that. For YJ, I'm curious to know if Anadarko has any activities that you classify as speculative.
Not per se. Given the portfolio of assets we have, we typically, like I say, try to hedge our forward production. Is the biggest piece of our positions that we would put on the marketplace, as well as some of the time spreads and location spreads on either transportation and storage. So everything we do is, from the corporate perspective, is vetted and really looked at to head anticipated future production.
And then just as a follow-on to that, has Anadarko noticed a change in the ability to access markets for hedging? And if so, could you kind of illustrate that to some degree?
Well, I think besides the regulations, the other thing that's impacted the amount of liquidity is just the lack of volatility. And then some of the banking participants in the market has disappeared, there's no doubt. And so it is a little more challenging to execute the hedges that we try to put on, particularly as we go further out the curve. I think we would have liked to have maybe have a little bit more long, elongated hedges, but we typically now stay within the 12 to 18 month time period as a result of some of the liquidity that and the bid-ask spreads that we see out there.
And I'm just going to ask one last question, and then I'll let everybody else have a shot here. In terms of the availability of counterparties for hedging, do you see a trend at this point, or do you see that there's been some kind of change that that you've just described, and that you reached sort of a stasis? I mean, do you perceive that liquidity is improving, holding the same, or decreasing?
I think it's kind of steady, leveled out a little bit. So I don't think we see the same degree of change we saw in the last 2 or 3 years. But any additional burdensome requirements or additional restrictions on limits, we are concerned that would further limit the liquidity in the marketplace.
Thank you. I saw Jim's card go up first.
Thank you. Question for clarification for, I guess, anybody on the panel. The term a phased-in approach could mean a couple of different things. One possible meaning would be a proposal is enacted as a final rule, but it has different compliance dates for different timeframes. I gather that is not what you mean. I gather what you mean is a phased-in approach in which a rule is passed that deals with one particular phase, spot month, and then a separate rule is passed to deal with other phases. Do I understand you correctly?
Jim, that's an excellent question because, for example, I mentioned a number of other rulemakings with phased approaches, as you point out. In some of those cases, there is a final approach that has different compliance dates, but FIA believes in this regard that a phased approach should suggest that for the non-spot month, that there be a separate rulemaking to enable market participants to provide comment as well as the Commission gains experience in implementation of an existing rule that would deal with the spot month.
I would just add that MFA concurs with that, and in particular believes that the data that we'll gather and the improvements on the data that we already have that will occur during the first phase would probably necessitate a reproposal of the second phase anyway. So that's why we would advocate for a separate rulemaking for the second phase.
Commissioner?
Yeah, one of the challenges that were identified in the first panel this morning to an authorization to the exchanges to manage non-enumerated hedges is the area of over-the-counter products. Could you see how perhaps a phased rulemaking approach might also be suitable for dealing with that problem, that we might be able to learn things from an authorization for listed products before moving on to perhaps over-the-counter products?
I think anything we can do to get additional data and to understand, what's behind the data would help us set establish limits that are reasonable and achieve the objectives that the Commission is looking to achieve here. So yes, I do think that once we get some better data, we can expand it to also look at the OTC area as well.
And just to elaborate on that, I think that the data that will require the greatest deal of attention is this question about open interest and looking at the data of the OTC swaps market in conjunction with the futures market. And I noted, Wajay, in your presentations, you talked about the spot month and looking at deliverable supply with respect to physically settled contracts versus the financially settled contracts, where perhaps one should look at open interest. And in the current proposal, one of the greatest challenges I think FIA has recognized and others have recognized is for the non-spot month relying on the open interest data of futures without necessarily taking into account the size of the OTC swap market.
And I'd just add, I think in phase one, you still have the existing exchange, position accountability levels for the non-spot month. So phase two is really moving that towards, both a federal as opposed to exchange level position accountability limits in the non-spot month, but also then bringing in the OTC portion into that as in addition to the exchange trade portion.
Brian?
Thank you, and thank you for your presentation. It seems as though that we're seeing a lot of commonality in terms of possible approaches to this issue of limits, and a lot of consistency in terms of support for spot month limit regime and the accountability mechanisms that are in place today seem to be getting a great deal of support from the community, which we believe is the appropriate path forward. There were some comments that were made, and happy to hear that they were made in the context of why we're here and assuring the consistent performance of these contracts, in particular having confidence in contract convergence, which is very critical to why we have hard spot month limits regime in place today for many of our contracts. However, I would have to emphasize the positioning and making sure that you have that confidence in terms of contract convergence. We would not be supportive of having a difference of limits between physically settled and financially settled products. We do have concerns in the context of any changes in dynamics there. Not having a one-for-one parity in treatment could actually have a very detrimental effect to the overall performance of that physically settled contract.
I believe Russ is next, and then Ben.
I'd like to ask the group, who can tell me what the deliverable supply of electricity is in the United States? Does anybody know? Well, I tell you what it is. It's the demand for electricity, because electricity is a constant delivery product, unlike any other commodity that we're talking about here. And as a constant delivery product, when you start talking about things like spot month, and you start talking about things like having to enumerate your commercial hedges, which commercial end users are responding to changes in demand in real time, I have to tell you, our members are exceptionally compliance-oriented, but I don't think they can comply with this. I don't think any electric utility can actually comply with this. So when we talk about commodities, every other commodity that we're discussing, everything you say is true, but I don't see how that's true for the electric commodity, because it's unlike any other commodity that we're talking about.
Thanks, Michael. Thanks for the presentations. We'd agree with that phased-in approach as it was clarified how it was defined. And in simple terms, the reason is that there's a heck of a lot of work we have to do to even get it right in the spot month. Examples. The presentations that were from this morning that were very well done in collaboration between ICE and CME, which is novel in itself. But just to implement that in the spot month and to think about all that dynamic and process that needs to get sorted out between the exchanges, the commission, and our market participants, we have to get that right. We have to get that right for our market participants so that we don't slow down their ability to execute hedges and reduce risk. Second is the definition of an enumerated hedge. There's still a lot of work on what qualifies as an enumerated hedge. There's been a ton of comments on this from commercial market participants that the Commission has received on this, and we need to get this right. And it's not just an energy issue, it's an equal issue for participants in my agricultural markets. Third, that's been brought up a couple of times in this panel, which I appreciate, is that the deliverable supply definition, we need to get that right for our customers. It needs to be accurate and reflect the true amount of supply that can reasonably be delivered at delivery points. And YJ, you brought up the example on natural gas in your presentation, and I'd also highlight a recent filing we've made around Zone G in power, where based on comments we've gotten from market participants, that deliverable supply estimate for power needs to be updated to reflect commercial reality for that point. Fourth, I'd highlight is just the pace of overall change and the potential of all this change getting implemented on our commercial market participants has the potential to drain liquidity from the exchanges to the bilateral OTC markets, which I believe runs counter to some of the objectives of Dodd-Frank.
Loba?
Hi, I'd just like to go back quickly to the Commissioner's question about OTC contracts, and I do agree with everything that's been said today. And I think that, especially for OTC contracts, I mean, we don't agree that there needs to be limits outside of the spot month. But if there are, we think there should be a minimum at least 12 to 18 months of data before the Commission even considers that. And part of that goes back to the regulatory burdens that I mentioned earlier. And those burdens are increased for OTC contracts since they're not standardized and they have individual forms. And so there's a lot of work that's going to be needed under the proposed rule for end users just to comply with the record-keeping requirements, to comply with the transactional requirements. And those are compounded for OTC contracts going forward. And so there needs a lot of work to be done just to get the current regime right before we can think about expanding it to contracts where, as others have mentioned, there's even less liquidity and less need for it.
Professor?
Morning, I guess. No, afternoon. It's a pleasure to be here. Just want to make a couple of comments, in part responding to what Brian and Russ said. First of all, I think that a phased-in approach is a good idea because there is a anti-manipulation rationale for spot month limits that does not exist for outer month limits, and so I think that that should be the focus. In terms of the implementation of spot month limits, I agree with Brian that there's really no rationale for distinguishing financially settled from physically settled contracts. And the reason for that is that how does one manipulate a physically settled contract by demanding excessive deliveries against that contract, creating excessive demand in the spot in the cash market to drive up prices that allow you to liquidate the rest of your position at an artificially high price? Well, if you have a big financially settled position, you can exercise that market power in the physical cash market itself in order to elevate prices and profit the rest of your position. This is particularly true in the case of electricity, going to Russ's point, which is that the way that you would manipulate an electricity market is withholding some physical asset like generation or transmission. And you can do that to advantage a financially settled position. And so I don't think that there's any justification for a distinction between these two. Actually, I wrote some articles about this 15 years ago about this specific issue. So I think that this is something that deserves some more attention. In terms of the definition of deliverable supply, one issue that's always struck me is the potential inconsistency between the definitions of deliverable supply for the purposes of position limits and the way that the Commission has treated deliverable supply in some manipulation cases. So I think that that's something that deserves some further thought in order to make those things consistent.
Lau?
It is all about liquidity. I really hope I don't live through another financial crisis, but if I do, it is going to be the result of illiquidity in the market. I can't set the regulatory agenda for the Commission and financial regulators in general, but if I were to set that agenda, I would be focused on how to reduce liquidity in the market, how to increase liquidity in the market, because at the end of the day, it is just paramount for our hedging on exchanges, our access as a corporation to capital markets. We're starting to see the trickle-down effects of financial reform on just liquidity in general, and I'm really fearful that is going to cause the next squeeze and the next crash and the next crisis if something's not done to kind of reverse that. The focus on liquidity here is great. I think that's right. I think if we do go with a position limits regime, we really need to see the impacts of that regime on liquidity in the spot month first, before we start imposing the limits on outer months. Already in the electricity markets, we're seeing some markets that just aren't trading really at all outside of the prompt year, even some within the prompt year outside of the prompt 3 months. So we're already seeing the impact of liquidity out the curve, certainly in the power markets. And before we sort of put a position limits regime on all months combined and spot months, I think we really need to study the impact of position limits on liquidity in the spot month before we move forward with the all months combined.
Mike?
Lael, I have to, your last statement is exactly where I was going. I think what this does now, and I'll summarize just a few of the points that the panel brought forth very well. It allows the Commission with a phased-in approach to actually do a phased-in economic study on the effects of the marketplace of these position limits. In my history and seeing how the Commission performs, I know one of the most difficult tasks that are charged with is actually coming forth with a bona fide good economic study of the impact of these rules and proposals. Doing this, we basically have not only a phased-in implementation of the rules themselves, but a phased-in economic study. So pointing out why, Jay, you said right now your numbers show there's a 5.7 BCF deliverable capacity at the hub, roughly over 4,000 contracts under current rules per participant. I know, William, you pointed out the current CFTC funding issues that exist, and the CFTC's ability to look at data, study data, get data even. And you also pointed out the existing statutes and also examples of past history where the CFTC has actually used a phased-in approach. And then finally, Stephen, you alluded to something along these lines, I believe, in your presentation as well. So to me, it makes sense to have a phased-in approach, not only of the rules themselves, but also to benefit the Commission, given the unfortunate past history we had with the first position limit round that we had with the vacating of the rule in the courts. I think it behooves both the industry and the CFTC to look at that just from the standpoint of having that phased-in economic impact study. Thank you.
Jim?
2 points. First, I'm going to take the risk of disagreeing with Professor Perrong, at least ever so slightly. So in the discussion of whether it is sensible to have different sorts of position limits for physical versus financially settled derivatives, Professor Perrong's arguments for having them the same were largely based on manipulation arguments. And I would like to note that manipulation is illegal, has been illegal for approximately forever, and will remain illegal. The role of position limits isn't to make manipulation illegal. The role for position limits is to reduce the threat of excessive speculation. So if we assume we already have an effective anti-manipulation regime in place, the question then is, given the effective anti-manipulation regime, what is the propensity for something to create the threat of excessive speculation? And I won't belabor it further, but I think assuming the effective anti-manipulation regime, I think the financially settled have a far lower threat of excessive speculation problems than the physically delivered. Second, if I can follow up on a point Lael made about liquidity, in response to a different question, some of our folks had pulled together some data that yesterday I'd shared with the chairman and this morning with Commissioner John Carlo. I hadn't anticipated using it at this meeting, but we had looked at bid-ask spreads and market depth in the natural gas financial basis markets out 1 year. And when we looked at that data, we observed that the bid-ask spreads across most of the delivery points had widened a little bit, although bid-ask spreads were still quite tight. If there is a liquidity problem, bid-ask is not where it was manifesting itself. They also looked at what they call depth of market. So the question you ask the trader is, on a normal trading day, how much volume could you transact without moving the market? And there have, in fact, been substantial reductions in market depth since 3 years ago. In the case of the most liquid eastern points, the traders were saying that 3 years ago they could do 5 contracts a day worth of business and not move the market. That's down to 1 contract a day now. So that is a sign of what I might call a fragile market. You've got nice tight bid-ask spreads. You can get in and do 1 deal. But if you suddenly need to do a lot of business, there's not the market depth to support that. And that is problematic for consumers because in the current environment, low prices, low volatility, the big consumers of gas have less incentive to hedge. But if conditions change so that now they suddenly want to put a lot of hedges on place, it is not obvious that there is the market depth to support that. And of course, the way the market will react is we will see bid-ask spreads widening dramatically, maybe prices changing, and eventually that will draw more participants into the market. But as the market stands right now, there is a sign of fragility in the form of this dramatic reduction in market depth. And I had not intended to use that at this meeting, so I don't know what I need to do to get the piece of paper I gave you onto the record, but I'll defer to your judgment on that point.
I was going to ask you that. Since you mentioned it, Jim, if you could have something to go on the record of the committee meeting.
Will do. And Mark, I can give you a copy also.
Okay, well, I would like to thank our panelists for some very rich and well-informed views. And at this point, we'll take a break for lunch. We'll come back promptly at 2:15 and conclude with our third panel. Thank you. Okay, it's time to begin our final session. Would everyone take their seats, please?
How are you? Oh, good. Let's catch up afterwards. Okay.
I know.
Ready to kick it off. Let's get to work.
Okay, we're ready to begin. So for our final panel this afternoon, we are going to be discussing trade options and forwards with embedded volumetric optionality. And continuing on with our excellent panels from earlier this morning, we'll let this panel introduce themselves and begin.
All right, let's time to have some fun. Nothing more exciting than talk about a little trade options this afternoon. There's three of us here, and we've just been talking, and this is going to be, really, I think all of us hope this is going to be as much of a conversation as anything else as we go. So I don't want to spend a whole lot of time on our presentations. I really would like to hear some feedback as we walk through this. I think it's been nice this morning. It felt a little bit like a workshop there for a little while, and I think that's kind of what we're trying to do. So as we kind of go through this, I think Michael will lead us through it, but bear with us. We're going to throw up a couple of pictures along the way. We may reference them back later on, but we're just going to kind of walk through this and kind of let you know what we're seeing and then kind of what we're doing as an industry, and everybody can jump in.
Okay, just a bit of mundane before the fun. Our disclaimer above states that materials and statements expressed in this presentation do not necessarily reflect the views of any particular company or association with respect to any issue discussed herein and are not attributable to any party other than the presenters. And just to reiterate what Paul said, really the goal of our slides today is to set off some scenarios that are representative of some of the discussions that are going on. And we do look to the rest of the committee today to provide their views and thoughts as we review our slides. So just keep track of things you hear us say, and in our discussion portion, we'll certainly open it up for that.
All right, well, since we were here last time, we obviously the proposed TO has come out, and I would say that generally supportive of Southern Company, we like it. Most of the folks we've spoken with generally like what happened in the TO rule, or proposed TO rule. Look, there's some things we'd like to say maybe tweaked or changed a little bit, some modifications or some clarifications along the way, maybe particularly in the preamble guidance. But on a whole, it felt like a very good move forward in the right direction. There were a couple of things perhaps we were slightly disappointed on. It would be with no mention of the position limits exemption in the trade option rule. We would have liked to have seen that. Simply one reason, because the order seems to matter. And if we could get that kind of taken off the table, it might clear things up. And when we talk about position limits and we comment on position limits, if trade options aren't a part of the argument, I think it makes things a little bit clearer. There might be fewer commenters, and we even talked about it a little bit this morning. It maybe helps, makes it easier to define the size of the OTC markets. We, as Southern Company, are in the process of reevaluating some of our contracts as we look at the EVO rules that came out in December as well. But the clarity has also been very positive. I think we have a little bit of a sign of relief, some of the changes that were made to the 7-part test in particular. However, I think since then, as we have sat in some of our the various trade association groups, whether it be EEI or ICA or just conversations amongst ourselves, we've had a fair amount of conversation in the last several months since at least the TO rule came out about the treatment of capacity contracts in the electric markets and the way we look at contracts that allow for zero or nominal delivery. So we'll talk about that a little bit more as we go through this afternoon, and maybe talk about, is there some ways that we could, in the TO rule, where perhaps the Commission might be able to provide a little bit more clarity. So with that kind of said, we'll move forward a slide. And if you will forgive me, I'm a accountant, risk manager by trade, not an artist. But if you will kind of look at that, and maybe you can kind of envision a bridge. And this kind of was inspired by the comments, but the Joint Association filed some comments, and they talked about the bridge between forwards and swaps. So when you look at that, you see on the far left, kind of in the brick and mortar, there's simply just a good old-fashioned forward contract that's going to be physically settled. If you move over to that first span, we talk about a forward contract with embedded optionality, still with the intent to be physically settled. When we start to get to the middle of that bridge, we labeled a standalone commodity trade option. May have a little bit more option at the beginning of that, but it's still intended to be physically settled. We believe that facts and circumstances would provide a lot of support in that determination. As we move farther to the right, we see commodity options, your traditional commodity options, financially settled, obviously, and then far right, just a straight up financial swap on the far right. Now, all we've done at the bottom is on the left, underneath the forward contracts, we've from the Act, we've taken what a swap does not include. On the right-hand side, we talk about what the definition of a swap is. I'm not going to read it to you. I think everybody's seen this multiple times. Certainly on this committee, probably people have spent a lot of time reading those words over and over and over again. What I would really like to put out there and make sure that we as an industry and you as the Commission and the staff, I've had this fear that we have nomenclature issues for a long, long time. And when we say one word, it means something to the industry. We say that same word, it may mean something different to the staff. And I'm afraid that's created a lot of confusion. And sometimes the only way you can clear up that confusion is just let's talk about it. And that's what we're hoping we can do today. So also, if you look at that bridge, you'll see there's the letters A and B. And I mentioned somebody during the break. If I'd known somebody was going to mention the tomato example, maybe I would have made those tomatoes. But some of the comments, and Commissioner Bowen recognized some of, I think, of our concerns in her comments at the end of the TO rule, that the energy industry, we have some contracts that when you first look at them, you may say, well, that kind of looks like there's an option there. But when you dig deeper, you realize, oh, wait a minute, that is a contract that is used for physical purposes. And the only way that contract can be settled is indeed physically. But what I've tried to do on this slide is point out perhaps two different places that someone can make can use their judgment in determining what a contract is. So if you see where the letter B is, I believe this is where we as an industry are drawing a delineation between a contract that has an intent to be physically settled, and therefore we would run that through the 7-part test, the 3-part test, all of our embedded optionality tests. I think the tests, the way they're written, kind of support that. And the way that we get there is kind of a play on words, is the bridge of facts and circumstances. I know that there is some guidance that goes back to the mid-'80s that talks about how we're supposed to view certain options. But I would contend that back at that point in time, we did not have energy markets under the same jurisdiction of the CFTC as we do now. Certainly not physical contracts as we do today. In addition, because our energy markets are so different than an agricultural market, particularly when it comes to things like storage, we can't just build a silo and store a bunch of electricity in it. Even in the natural gas market space, storage is limited. Everything's very regional. So I think the facts and circumstances allow us to look at that point B as deciding what is intended to be physically settled. And I acknowledge, as a market participant, it is up to me to keep enough records that I need to. So if anybody asks the question, I can show them, yes, when I did this transaction, I intended to be physically settled. However, at the end of the trade option rule in the comments section, there is some language there that would lead you to believe that some may be viewing the delineation point at point A. And that's what I'm hoping we can talk about. When we have, and I'm going to move to the next slide real quick. And I'm going to walk through an example for us, for Southern. And I'll mention gas a little bit, and then I'll let the people with me on this panel talk a little bit more in more detail. And we may come back to that slide we looked at a second ago. But just as a kind of a refresher of where we are, Southern Company, we have a lot of capacity. We have a generation fleet. And generation to us is capacity. Now, our generation fleet is pictured up there with the bad drawings of some little factory-looking thing. But you'll see there's check marks on several of those. And you'll see some of those labeled with PPA. So we may have a power purchase agreement. And so you could look at that and maybe say that's your generation fleet or your generation portfolio. And so we look at all of those, and every day we run what we call a multi-factor dispatch model. And we take lots of things into account to determine which plants or which capacity we're going to call on. Now, we view a PPA in this model the same way we would view a plant that we built ourselves. We pay capacity payments. There's charges we make on that. And so depending on what's going on, so for example, if it's 98 degrees outside and I've got a plant that happens to be in service, be out of service, well, I'm not going to include that in my mix for that day. I'm going to include things like how efficient each plant is, how available it is to run, fuel cost, because I may have some of those plants may be coal, some of them may be natural gas, some of them may be renewables, solar, wind. There's a whole list of factors. And so I'll determine that every single day. We constantly are running these dispatch models. And that's how I determine what I'm going to call on. It may mean calling on a contract, but that's what I'm going to use to determine how I'm going to get the electricity to my customer base. And fortunately, I think the revisions that were made to that 7-factor test were beneficial for us because it made things a little bit clearer when we go through this process I'm describing in the pictures. So for power specifically, we do have regional physical markets. Electricity is unique, and I know y'all are probably tired of hearing this, but we can't stop saying it. Electricity is real time. Our business, we are entering into, we have to have capacity and energy at the same time. We can't have energy without any capacity. And if I had a contract of a PPA, it might be 100 pages, might be 200 pages, it might be with somebody else on this panel. Let's say it's a contract I entered into 4 years ago. When you evaluate that contract, you would see capacity payments. You could look at the invoices. You see capacity charges for X million dollars and however many thousands of megawatts. You would see energy charges on there as well. That contract has produced power every single month that we've had it in effect. However, those contracts also have to retain the ability to take zero, because we have to protect the integrity of the grid. There are times when there's more electricity produced than there is demand, and you can't threaten the grid because of that. Now, you also have the inverse. So I'm getting to this idea that there's a time and place, particularly in the electric markets and the natural gas markets as well, where it is perfectly acceptable, and I believe it makes absolute sense that we may have to that our contracts allow us to take zero or a non-nominal amount, I think is the phrase we've used. One thing that I think is also interesting is we call these capacity contracts because there's capacity and then there's also electricity. The accounting rules, the SEC, FASB, some of y'all have heard of the old FAS 133, mark-to-market rules, right? And we got a few accountants around here. This was put into place with FAS 133. It's now called ASC 815. The FASB is actually already kind of ground through a lot of this sausage we've talked about over the last couple of years, in that they recognize that there are contracts that when you look at those initially look like derivatives, but when you get into the meat of them, that they're really not, that they're intended for physically settlement. And FASB and the SEC, they have something they call a normal purchase, normal sale. And they designate some electricity contracts. It's a fairly high standard, but they designate some of those as normal purchase, normal sales. So they're not included as derivatives. And so I have this fear, and it's reflected in our comments, that if we're not careful, we could end up with a situation where I have a swap as defined by the CFTC that is not a derivative per my accounting records. And that is not where I don't think anybody really wants to end up. The way that I feel like we can kind of bridge that gap using the bridge analysis is there is a facts and circumstances element to all that our industry is utilizing and using. And I think we're relying on that because we can demonstrate that even though we may allow for a zero or non-nominal delivery, we can demonstrate that these contracts are being used every day to keep the lights on, or a day like today or a summer like this summer to keep the air conditioning on, right? And we have to do that. The gas markets, and they're going to talk about this a lot more, are very similar. They're regional in nature. Their storage is not unlimited, kind of depends on where you are. Their real-time nature of their business, partially to support our business, also requires the ability to take zero, but it does not ever change the intent to physically settle. And in those instances as well, I think we're talking about a facts and circumstances analysis that should allow us to take our contracts, which we're going to view as physical contracts, and run those through the tests that we've come up with the last few years, because we would not want to end up with a situation where we could not utilize those tests that we've all worked so hard on. I think I'm going to turn it over to Rushi, and she's going to walk through some more.
Thank you, Paul. Just to reiterate some of the things we've just gone over, we've talked a little bit about the swap definition and about the interpretations. We've talked about the basics of facts and circumstances, and we've talked about also capacity contracts. So we're kind of laying out for you now sort of a framework for informing our discussion as a group. How does the facts and circumstances apply now in light of the interpretation and the proposed TO guidance, proposed TO rule? And in addition to that, what's happening in the market now that could be addressed in the final TO rule? And perhaps what other action items might be on the list for the Commission to consider in conjunction with that? And then separately, we can talk a little more about the exclusion of position limits applicability to trade options. Okay, so I have got a slightly more detailed example up on the screen discussing how the facts and circumstances analysis might be applied in the physical gas contracting space, taking as a basis for that model the very standard daily call, Platts gas daily, peaking supply contract. Call sometimes a swing, but the underlying point is that it's a secured firm right to call on natural gas. And I want to go into a little detail on how you get to that type of contract, because the devil is in those details. How we apply the facts and circumstances test is not simply a look at what a confirm or what specific deal says with respect to whether you're going to take 0, 10,000, or some percentage thereof. There's a lot more there, and I think one of the places we might be talking past each other in the energy industry and with the Commission, at least in some of the deliberations we've had through the comment docket, is a more full understanding of what it is that's happening pursuant to an agreement for a peaking supply where you may take 0 or a nominal volume. Okay, so where we started out on the slide here is that we're discussing a deal between a natural gas utility, a local distribution company, entering into a master physical gas or a base supply agreement. There are many terms for that agreement. I'm using a generic form here with a gas producer that has the independent ability to procure or has their own gas storage. And I put the date 1998 there to make a very important point, which is that there is a physical course of dealing that exists between a utility and its physical gas counterparties, which can date back years or even decades. And that course of dealing is reflected in a base contract. And a base contract is not, like I repeat, it is not the transaction's price and quantity terms. It is literally everything else but for that, up to and including things like liquidated damages if one party doesn't perform. Again, liquidated damages in the context of physical settlement. So if you were to not bring the gas to the receipt point, then you would pay a fee so that the utility could go out and buy that physical commodity somewhere else. Where the receipt points would be on the system, which will be further informed by the transaction confirmation. And most importantly, the master agreement itself, which is a physical supply, sale, and purchase agreement, does not create any obligation on either party to do anything, which means enter into any specific deal for physical gas, which is where you get the construct then for what happens in a transaction confirmation. So the master gas agreement sets up that very general course of dealing and defines the non-price, non-quantity terms of the overall agreement. Then you move forward in time, and I've used a date here. I think I've got a date up there, but this could be any time. This could be 10 years later, 5 years later, 2 years later. The gas utility is planning for its winter procurement, and it's doing that the May before the upcoming winter heating season. And the utility will go out, and depending on what the utility needs, again, referencing what Paul called sort of a toolbox, or a stack of the different types of procurement options that the company may have to fulfill its physical needs. The utility will go out through either a formalized RFP process or independent phone calls or emails or publishing a notice to the counterparties with which it has a master agreement in place, and puts out the request for proposals for satisfying certain requirements that the gas utility may need. And the purpose of doing that solicitation is to have it all in place, not necessarily to confirm delivery at that point or confirm delivery in the future. And the different types of deals, again, I've made some generic terms up there. Contracts are B1, B2, B3. These are all requirements, and you can basically check the box as a counterparty, and then you get to the point where you itemize your price and quantity terms and memorialize those in a transaction confirmation. And that's where, in this example, 0 to 10,000 or 500 to 10,000 or a minimum take of 6,000, that's where those additional terms materialize in the confirmations. So you can see there are 3 scenarios up there. One is interruptible delivery. That's fully interruptible by the buyer or seller. It's not necessarily even viewed as a forward obligation in the sense that neither the buyer or seller have to do anything. The second is a firm variable agreement, which will involve some sort of base or minimum take and some swing component, which may be a percentage of the base amount, or it may be an additional swing amount that's designed to serve a exigent need like the weather becoming colder than expected. The third contract is a pure firm call right, just a firm contract. It has no specific baseload or minimum take component, but it has a swing component, and that's where you have the 0 to 10,000 type example, where you have a peaking or a swing of an up to a fixed quantity, and that's reflected on the agreement. And just a reminder that each of these confirmations could be executed with any of the counterparties with which the utility has a base supply agreement. And then the food for thought for us to think about then is the very last portion of the slide. Given what we know about this overall agreement, how would you classify these contracts? So just think about that for a minute as we go into a little more on how the market is responding to the CFTC rules. This slide is sort of a very summary take that I'll go into just a little bit of detail on regarding where we are now and where we were following the interpretations release, the final embedded volumetric optionality interpretation, and where we could be moving forward. The first bullet discusses how clarity has been achieved on firm, variable, and interruptible. Those were the first 2 types of deal confirmations I discussed on the previous slide. And the important point here that the interpretation really helped with was this notion of a minimum take requirement. Before we had the interpretation, there was still some uncertainty in the market that if a contract required you to take a certain amount, a percentage take of that amount, if that was the actual amount delivered under that contract, that may be inconsistent with the prior 7-factor test That clarity has been achieved for a lot of market participants, and I think that that's where I think Paul and I might both agree that we really feel like we're in a better place with the interpretation. But then we're not really here to talk about just where the clarity is, but where it's not. And that's in the last contractual example that I put up there on the previous slide, which is the treatment of firm by market participants. That, to this day, is inconsistent. There's a few reasons for that, and I just kind of want to go through a couple examples of what those are. First of all, this notion of zero delivery. As Paul was saying on his former slide, regarding the bridge, there were two inflection points where the analysis starts and stops as to whether we're talking about a forward, a physically settled option, or a trade option. And minding the fact that a trade option or any option is just treated in the CFTC regulatory landscape as a swap. So right now, we've still got concerns in the marketplace about how you would characterize those contracts. And I love Paul's usage of the word nomenclature. Nomenclature has really been the issue. And the agree to disagree clause has been rampant in how gas counterparties have modified their physical contracting relationship. One counterparty, which is more sophisticated potentially and is already doing a lot of work to report other trade options or other swaps, may decide that that agreement is a trade option and report it as such. And the other counterparty, even though that counterparty is filing Form TO, since TO, for example, is a form that needs to be filed by both parties, if that's an end-user to end-user deal, then the parties may agree to disagree on what the transaction is classified as. And we've got a lot of examples in terms of form agreements that have been pervasive in the marketplace. IECA is a good example. The IECA did a form letter representation quite a few years ago that would memorialize that people may disagree ultimately as to how they classify that contract for their reporting purposes versus how they classify it internally to their company. And another thing that we're seeing right now is that smaller suppliers, independent producers, marketers, storage providers, again, emphasizing this notion that these are smaller end users, often entering into these deals with other end users, which may be larger, but nevertheless may not have a single other CFTC Part 45 reporting requirement. These smaller suppliers are still not responding to solicitations or RFPs that are very similar to or identical to the types that I discussed on the earlier example slide. And I've gotten the question, well, what's the problem now? The TO reporting requirement may disappear altogether. What is it? Why would these market participants not come back? And I have a few points about that I'd like to share. One is definitely that there's still uncertainty about the zero delivery contract. And the smaller market participants really, because they don't interface with Dodd-Frank in any other way, would not want to invest the time, resources, legal fees, and some of the other requirements to figure out why it is that they might be regulated by Dodd-Frank. So the specter of dealing with Dodd-Frank for a purely physical small producer, an independent counterparty that does not have to deal with any of these requirements in any other context because they have 100% physical business, is a sufficient incentive for them to not respond to that type of RFP. What happens if you do enter into agreement and one of your parties, the other party, another end user, wants to report that transaction as a trade option because of this uncertainty? Well, then you as the other counterparty also need to report that transaction as a TO. You need to obtain an LEI. You need to engage in, if the trade option proposal were finalized as written, you still need to engage in some amount of due diligence and record keeping, tracking and monitoring if you're going to be entering into any volume that the other side may end up reporting under the proposed 1 billion requirement. You still need to enter into reps. You would need to modify your basic transaction confirmations. Again, these are the actual deals, B1 through B3 in my example, not the master gas agreement, but the actual deals, to make sure that you're consistent with the underlying terms of what the interpretation or some amalgam of the interpretation, as well as the prior products release, and potentially what might be said in the trade option rule. And I have to impress upon you also that reps in the industry look completely different. To the extent that transaction confirmations have been modified in the gas space, it's just so that counterparties can make sure that these are treated as and viewed as physical deals. Those reps can take the form of specifying 1, 2, or 3 of the 7 factors. They can take the form of taking a little more of that, or a legal interpretation thereof that references back to these releases from the Commission. And some counterparties have a problem signing on to reps for physical delivery agreements that don't all look the same. So the amount of negotiation that can go on to get those same physical firm call deals done has really been immense for some companies. And that's a burden in and of itself. So those are some of the basic issues that we're still facing and where we'd like to see a little more clarity. And I know that one of my co-panelists, Amy, will be talking in a little more detail about a standby peaking contract where you can get a little more insight into the details about this uncertainty. Moving on, our slide, of course, is not just to tell you today about the problems, but also about solutions. We are, of course, very grateful and respectful of the fact that the Commission is looking at this issue. A lot of work has already been done on this issue, and we're here to suggest things that the regulator can adopt to help us get to a better place, and also to ensure that we're not in a place where we're talking past each other when, in fact, we may all intend the same thing, which is essentially that if physically settled contracts and those that are intended to be physically settled should not be in the swaps world. So for us, the TO proposal was an important starting point. I do believe, based on what I've heard from the smaller end users, both in the gas and the power space, especially in the marketing space, is that they could get back in the game if Form TO is no longer required. So we are very supportive of the elimination of Form TO. And I also think that it's been pretty well settled in the comment docket that there are some concerns about the alternative 1 billion notional reporting requirement, and that pertains to, of course, whether or not you'd have to be tracking if you fall somewhere in the middle of that. And I'll let the Commission consider those comments in the docket on that issue. Some of the other comments raise a very important point because they discuss the quantification challenges for valuation of TOs for the purposes of satisfying the bullet above, which is the proposed 1 billion requirement. There are some methodology proposals in the TO proposal that talk about calculating future price quantity, and what it really envisions is that there is some sort of cap or on how much gas or electrons, as it may be, how much of the commodity is actually taken, and what date and what price is listed for the commodity at the time of physical settlement. And the challenges of quantification really germinate from the fact that in the marketplace there's an attempt to fit in TOs that are physically settled and financially settled. And with that challenge before you, the question is, what is the appropriate way to report or track and value for reporting purposes an open-ended, physically settled trade option? And that issue has also been discussed in these comments and in the prior TO comment docket as well. And it's, of course, one of the issues that led to other no-action letters that the divisions have issued in the past regarding how valuation should occur. And it's the same story again. It's the square peg in the round hole, which begs the question that why are physically settled transactions being reported as trade options in the first place when they bear no other characteristics that intend any sort of alternative financial settlement? And to that point as well, something I missed on a previous slide was that to the extent in that example slide I shared, there are financial obligations built in or financial terms built into a master gas agreement or a base contract. Those puts and calls are pursuant to additional amendments to the master agreement, or there are actual phrases and language that is embedded in the confirmation agreements. So the market does a good job of putting out very clearly in documentation what type of deal you've got. You don't have a situation where in the gas world you would, for example, have a peaking deal and also have some type of severability of that deal that's not enumerated very specifically in a confirmation or in a master agreement. And so that again goes back to the TO proposal. It's like, what are we talking about here? How would I value a 0 to 10,000 deal under which I don't have to take anything, and I may not need to take it until next year when Gas Daily is showing a winter price that is 17 times the amount that it is right now in May? How do I value that? So that's another question that sort of comes out in the TO reporting context and has also been addressed in comments. So with the TO proposal being an important starting point for us, I think that we are in a place where we need to talk about what can be done in the final rule in addition to what is already in the proposal that will really help. We've got a few different points up on the screen, bearing in mind that the formulation up there is something that is reflective in other comments with slight tweaks, and goes all generally to the point that the final rule should clarify and affirm that physical contracts which allow for zero or nominal delivery may satisfy the CFTC's interpretations and guidance on forward contracts and would not be regulated as trade options in light of a facts and circumstances analysis demonstrating that such contracts exclusively intend physical settlement. That statement, which Paul and I worked on as a proposal, is replicated quite neatly in a footnote to the actual EVO interpretation as well. And the language of that states, and this is looking at note 32, the final interpretation. That's page 10 if any of you have the release. Depending on the relevant facts and circumstances, capacity contracts, peaking supply contracts, transmission or transportation service agreements, and tolling agreements may qualify as forward contracts with embedded volumetric optionality, provided they meet the elements of the CFTC's final interpretation. And in addition to that, in the interpretation itself, you've got several points noting that this is a facts and circumstances analysis consistent with the CFTC's prior precedent from the 80s, as well as with what is contained and preserved in the products release. So we're looking at a number of different documents, and what we'd like to do is be able to do exactly that, to undertake the responsibility of engaging in a compliance regime where we can use a facts and circumstances analysis and apply it broadly across the world of physical contracting, whether it's peaking supply, capacity, or any others, when the exclusive intent of those contracts is physical settlement. And right underneath that, I've got a point discussing that our views are consistent with a 7-part test. The test itself effectively contemplates that actual delivery may or may not occur. The CFTC has already clarified in the interpretation that's been released that the turning factor for whether or not you're within the forward exclusion is the intent to physically settle. So if the question is of intent, and we've struck language from the prior 7-factor test that gave the impression that it's how you execute those obligations and whether or not there was execution, if intent is the operative factor, then that's consistent with the fact that actual delivery may or may not occur. And that not standing alone, but in light of the other types of facts and circumstances that may exist, for example, the existence of a master gas agreement with your counterparty that only and exclusively contemplates physical settlement, that should be enough. And getting to that point can be tough on your own as a company because you have a culture of compliance that is very, very much interested in making sure you're following the rules. And to get that clarity from the regulator, would be everyone's preference. And we'd like to see that type of uncertainty diminish as much as possible. And we know that the Commission has been looking at this issue for years. And we think that the TO final rule preamble language, for example, is a good place to do that. The second bullet there is really reiteration of what I just said, that capacity contracts are another area where we really need clarification. Paul made a great point earlier when he was discussing what the exact issue it was with capacity contracts, and that was that those contracts produce every month, but you do have to retain the ability to take zero because we need to protect the integrity of the grid. There is a place and time for using peaking supply, capacity, and other physically settled contracts. and they remain as such whether or not there is a minimum take obligation. And that is something that we'd recognize very broadly in the energy industry. And there's certainly a way forward for us to use the voluminous guidance from the Commission to date to get there, but it looks like we might need something else. And finally, the final point is, of course, that we really do want to see that TOs are excluded from position limits in this final rule. And I must impress upon the point that one of the other reasons that you might not have some physical market participants entering into firm call agreements with any of the suppliers of the physical commodity in the marketplace, whether you're talking at retail or wholesale, is because of the specter that future position limits rules may be applicable to those trade options. And, just adding again this whole valuation issue and the simple idea of tracking a an exclusively physically settled trade option with quotes is replicated, mirrored, and certainly exponentially a larger problem if you were to try to track trade options for the purposes of position limits compliance. Paul, is there other points you'd like to add?
You made me shocked.
All right, Amy. Oh, we do have one more slide. Want to go over there? Okay, sure. Okay, so we did have one last slide, and that's something that's also food for thought for you up there. We've gotten a lot of questions about how the uncertainty around this issue is impacting liquidity in the physical marketplace. And aside from what I've told you anecdotally, I think the important point to remember is that we're looking at a statute that is about 5 years old. And by comparison, we're able to look at what's happening in the physical marketplace for gas and power in the traditional energy space under statutes that are bordering on 80 years old at this point. So to answer the liquidity question, and the long-term impacts question, there is a need to make sure that we're thinking about the time frame over which we would view those impacts. And I think it would be short-sighted of us to table the issue of liquidity, but also it's important to be aware that we're dealing with a new statute, new rules, a new guidance that's just going to start to be applied now, this year. And I think that where the Commission can go in a very positive direction, both for the agency in terms of addressing the issues that need to be addressed, and for the marketplace, is to really just hit this issue very directly in the final TO rule. And hopefully some of the discussion today we hear from others can be a shared perspective on how that might happen. All right. It's Amy, to you.
Hi, I'm Amy Fisher. I'm the Energy Regulatory Affairs Leader at GE Energy Financial Services. GE EFS is the asset manager of a limited partnership which owns the Linden Cogeneration Facility, and EFS owns 50% of that facility. I'm here today to talk about one of the ways in which Linden Cogen is able to arrange to receive uninterruptible natural gas. It's fuel for generating electricity for sale to New York City and to produce steam for sale to the refinery that it's co-located with. Linden Cogen is shown in the photo. It's located off of I-95 in Linden, New Jersey, and I'm sure many of you have passed it and seen its banner on the highway that says that it's energy efficient and environmentally advanced. It is co-located with the Phillips 66 Bayway refinery, which is the largest refinery in the Northeast. So all of your gas comes, or 20% of the gas in the entire East Coast comes from that refinery. Okay, that's good. So Linden Cogen is a modern cogeneration facility which uses natural gas efficiently. It first produces electricity, which is transmitted over an underwater cable between New Jersey and a Con Ed substation on Staten Island, New York City. The heat from the electricity production is then used to create a steady source of steam, which is critical for the Bayway refinery process use. Linden Cogen was completed in 1992 as a project-financed entity, which is a particular type of financing structure which allows it to be to obtain debt at a lower cost because it is more highly rated than its equity ownership. It was originally owned by its developers, which was a small company. That project financing is a wonderful financial technique which kind of creates a black box where all the contractual relations that the plant is going to have for the next 20 years are determined up front. And many power plants are financed in precisely this way. But the downside of it is there is limited flexibility after that for, unintended changes in costs or expenses that the plant might incur. Linden uses natural gas as its fuel, and it's the most critical component of its products. The map shows a simplified path for fuel delivery. So essentially, the plant goes to the Gulf and sources natural gas. It purchases the gas in the Gulf and arranges to have it transported to a gas hub where it is picked up by our local distribution company, which is called an LDC, and that's essentially what is referred to as its city gate. The LDC is a very highly regulated entity by state regulators. It's a public utility. It takes the gas that it buys from Linden at its city gate and transports it to the burner tip, to the actual point at the facility where it's used. The green dot on the slide is the Linden Cogen plant. The blue dot is the Con Ed electrical substation in Staten Island. And the purple line is the underwater cable connecting the two, which transmits the electricity to New York City. So local distribution companies nearby Linden Cogen are, as I said, utilities regulated by the New Jersey Board of Public Utilities. The LDCs have a service obligation for all customers in the region, and they operate under complex tariffs which describe different types of service that they provide to different classes of customers. The rates and terms of service charged by the LDCs need prior approval from the New Jersey BPU. So Linden has an agreement with those entities, and that agreement, which is a full supply, collectively a full supply agreement of 100% of its fuel needs, was approved by the New Jersey BPU. However, having said that, the LDCs are required by the terms of their tariffs, again approved by the New Jersey BPU, to provide a priority for residential heating purposes. So these LDCs, which provide natural gas to a large industrial complex like Linden, also are responsible for literally providing residents in northern New Jersey with their heating needs. And because of that, the New Jersey BPU requires that industrial enterprises, which obviously could swamp each individual house's, heating needs, that there be a second backup supply for natural gas for the industrial uses at such times when it is cold out, below 22 degrees Fahrenheit. And that at that time, there be another source of power, of natural gas, excuse me. However, it is not clear that at the time that those that those weather conditions exist, that the LDCs will not have enough gas to satisfy everyone's uses. And the BPU has another goal, which is to provide as much revenue to the LDCs as possible, so that so that they can function appropriately. So they're not anxious to have the industrial loads find some third-party source of natural gas. So the compromise is that Linden Cogen has to go out and find some kind of contract which will allow them to access that natural gas when told to do so by the LDCs because they themselves cannot provide the natural gas on particular dates. So the way this works is that the LDCs call up Linden a day in advance, and Linden calls a supplier with whom it has a contract, and tells them to go ahead and supply the power. The natural gas. The natural gas goes on the same path that I had mentioned before, up from the Gulf to the hub, and then title is transferred to the LDCs at the hub, and it's transported to the facility. So none of that happens unless the LDC calls up Linden the day before and says, go activate and nominate the gas under your standby peaking supply contract. Can you just go back one slide? But I just wanted to make this point because I think it's quite important. It's very critical for Linden to have 100% of its natural gas needs satisfied one way or the other. We have a firm contract to supply electricity in New York City. We're 8% of the load serving capacity in New York City. And we also have a very firm contract with the refinery to supply steam. We can't produce steam unless we're running, and we can't run without natural gas. So you would think we have two LDCs. One supplies 80% of our needs. The other supplies 20% of our needs. But because both of them can curtail us on cold days, we need to actually have another alternative. And the other alternative does not mean we're getting 110% of our gas supply taken care of. We're still at 100%, but we need to have a plan B on those cold days. Go ahead. Yeah, I guess we can. No, let me talk to this for just 1 second. So just to talk about the terms of the natural gas supply agreement, they need to be approved of by the New Jersey regulators. They only approve them on an annual basis. We go out on an RFP basis. We get a third party to commit standby supply. The charge for that is a reservation fee to stand by. The gas is priced upon delivery at the market price, and in the event that we're called on to nominate gas under these contracts, the utilities have by definition agreed to purchase the gas from us when it gets to their hub. So there's no ability for us to speculate with this gas supply. So I guess I would say, in just having heard Paul and Arushi comment on this, that I'm not even sure we're even on the bridge. But assuming that we are, and we're looking at a forward contract here and not just some commercial supply agreement entirely outside the scope of CFTC rubric, really, why do we need relief under the trade option rule? So I guess everyone, beginning in 2012, took a very, very close look at the nature of their contract relations, and specifically whether they were going to have additional reporting requirements under contracts like Linden's peaking gas contract. And I think when we went out and showed our outside counsel, who handles all of our Dodd-Frank reporting requirements, when we showed them these types of contracts, they said, well, it's a commodity and it's an option, even though it's not your option. And so it must be a commodity option subject to swap rules. And we'll give you a break, and we'll call it a trade option, not some other sort of swap. And therefore, all you need to do is file this form and, follow some of the reporting requirements, and you'll be set. And that created several issues for us. The first was just a sense that that our people who run the Linden plant would not necessarily realize that this would be considered a trade option because they don't have any optionality with the contract. So there's a concern that we have that we might miss some requirement, even though those requirements might be less, might be nominal. As Paul suggested, there is a significant accounting issue. The normal purchase, normal sale type of accounting that we would apply to a peaking gas contract was put in question when we started looking at these agreements as though they might be trade options, and that caused all kinds of consternation until we kind of worked through it. In addition, there are, the requirement that we somehow track these separate from our other commercial arrangements is very problematic. Arushi mentioned the valuation issue. I would say that the release as proposed suggests that there ought to be some sort of mark-to-market because we are, pricing this thing as we use it rather than having a fixed price. That is a big burden for us for some of the reasons that has been suggested. So we, would go back and challenge our counsel to maybe come to another conclusion. But because of the record around this issue, at the commission, it's very difficult to find a counsel that is not going to immediately say, look, this is a nuanced issue. We're not really sure how we should come out. So we really think you should adopt a conservative course and report this as a trade option. And that's precisely what we've been doing, particularly as the panelists have suggested, our counterparties have been reporting these as trade options. Do you want to go ahead? So in light of what I've been suggesting, we would suggest that these contracts in particular be taken out of the trade option category. We realize that through the rule, the reporting requirements have been reduced, and we very much appreciate that. But we really think that it is just not accurate to think about these types of arrangements as options at all. And it would be helpful for us to have that acknowledged. We think this issue has been outstanding for us since 2012 and has really caused a great deal of thinking and a great deal of confusion in our organization. We think that the trade option rule is where people will look for guidance on this point, and so we think it would be great to make the clarification in the rule itself. We very much appreciate Commissioner Bowen's proposal, but we think that unless there's some kind of clarification in this rule, people who are not as sophisticated as the people in this room will say, well, the commission had an opportunity to clarify this. Commissioner Bowen identified the issue. They chose not to, so therefore they must consider these items to continue to be trade options. I wanted to just spend one more minute telling you why this is important to not just Linden Cogen, but to the industry as a whole. In several of the regions where there are independent system operators who balance the grid on a regional basis, so, that's New England specifically and PJM, the Mid-Atlantic states, there have been new rules just very recently put into place which very dramatically penalize entities that don't deliver power, generators that don't deliver power when they're supposed to. And although in the past there's been some belief that not having natural gas would be a reason and excuse to get out of those penalties, it is quite clear now that that is not the case. So because, not dissimilarly to what Paul mentioned, there is a dispatch stack, and you're never quite sure when you're going to be called, when you're not going to be called as a generator. It is difficult to commit to firm natural gas resource all the time, 24/7. So there's really going to be a need to get firmable contracts, not unlike standby peaking gas contracts, in order for generators across the region to meet their reliability requirements that are now imposed upon them. And I would suggest that if the Commission does not take this up now, it really will have to take it up again at a reasonably reasonably soon basis. So thank you very much for listening to this story. I hope it's provided some clarity of how something rather abstract can affect small businesses and small end users. Thanks.
I saw Russ had his card up first, and then Jim.
Thank you. Our concern with the question of trade options being deemed to be swaps, which arose in the product interpretation from 2012, without regard to the statutory construction issue, is that if a trade option is a swap, and as I told you at our last meeting, with respect to our members, there's only two possible outcomes with a trade option: either physical settlement or no transaction happens at all. And in light of that, if something's a swap, we have all this collateral damage that happens across multiple CFTC rulemakings. Because, for example, it throws us in to record keeping and reporting for swaps in the deep end of the pool with swap dealers and major swap participants. And we're tiny little physical end users. But now we find ourselves subject to reporting and record keeping requirements, the same rules that apply to the largest and most sophisticated financial institutions on the planet. And there are substantial costs that we would incur complying with those rules. And it's not just record keeping and reporting. We have potential problems with respect to margin, capital, et cetera. There's no cross-reference that would remove a physically settled trade option from all the other swap rules across the sphere of CFTC reporting and record keeping and any other rule that refers to the term swap. So that's our real concern with it. And I just want to thank Arushi and Paul and Amy, because I thought they did a great job on presenting sort of the current state of affairs as far as the industry thinks with regard to trade options and enumerating the concerns that we have. So I appreciate it.
So thank you. I wanted to follow up on one of the points, and I have a handout, and Ajay's got this file, and I'm assuming Ajay can do whatever needs to be done to get it officially into wherever the record ends up. And I'm very sensitive to the bad outcomes that have been talked about from the current trade option rule, not the proposed rule. I'm not sure I agree with the ambiguity. I think they're unambiguously bad outcomes. And whether that's better or worse than ambiguous bad outcomes, I'm not sure. The proposed trade option rule, from my perspective, fixes almost all of those problems. In the proposed rule, however, the Commission declined to answer clearly the question of how trade options would be treated in the position limits rule. Many of us in our comments on that proposed rule did comment that the final trade option rule would be the correct place to address the question of should trade options be within scope for position limits. And I believe it was unanimous that we said, no, they should not be in scope. The question that I asked our folks to take a look at is, if trade options were in scope for position limits, how much would that add to our cost to comply with a position limit rule? So this is only the incremental compliance cost associated with looking at trade options in addition to everything else. So the trade monitoring group within our compliance department has taken a look at the processes they would have to go through, and page 2 of the handout lists the various elements of the costs that would be incurred, and they looked at a minimum value, an expected value, maximum value. Page 3 then shows the results of the simulation they ran. The expected value of the costs we would incur on an ongoing basis is a mean of about $435,000 per year, standard deviation of about $85,000. So call it $500,000 a year. That's per year for one company in the trade options. I would argue that the costs we incur will probably be substantially lower than the cost some kinds of market participants will incur for one very good reason. If you look at the detail on page 2 of what drives the cost, the big item is one we've labeled as trade option identification. A big part of that is, under the position limit rules, options have to be treated into position limits on a delta equivalent basis. So you have to be able to calculate the delta of the option as it existed at close of business the previous day. And that delta equivalent of the option is the contribution that option makes to your position during the following business day. So you have to calculate the delta of these options every day during the spot period. We can do that because we run these options through our risk systems. We routinely calculate deltas for them because that's how we manage these positions. I am not at all sure that an LCD or Linden Cogen or any of the other big consumers that are the natural counterparts on these options, I am perfectly willing to believe they know what delta is. I have no reason to believe they bother to calculate delta on these options because they have no need to. Linden has to have these options. All they care about is, do I have to use the option today? Did my natural gas supplier call me this morning and say they were exercising one of those 22 days when they can curtail me? If so, I have to exercise my option. All they care about is the option exists when they need it. They do not care about the delta. So what is it going to cost them to put in a system to calculate the deltas for these things that they have never even considered to be options? So it costs us a non-trivial amount of money at the margin, as best we can estimate it. I think our cost probably is a gross underestimate of what it's going to cost a lot of market participants. And the market participants who have to pay the most are those who are the natural users of these to satisfy perfectly normal business requirements, such as the panel just described.
Jim and then Andrew.
At the risk maybe of belaboring a point, I wanted to just emphasize the crucial need for volumetric optionality in electricity supply arrangements. As all three panel members have indicated, an electric grid operator has to balance the demand for electricity and the supply of electricity instantaneously in real time, and there are no choices. If there are appreciable deviations of supply relative to demand, either too little supply or too much supply, the lights are going to go out, and that's just a matter of physics. And this task of balancing demand and supply real time, it's becoming more, not less difficult, and it's becoming more difficult. And for one reason is that the society is tending to rely more on renewable resources to provide its electricity, and primarily for environmental concerns. And if you take a typical renewable resource like solar photovoltaics, for all its favorable attributes, it has one sort of really unfortunate characteristic, and that is it's intermittent, and it's intermittent in an unpredictable way. So a solar panel can be generating a good deal of electricity when the sun's out, and on a hot day, and then a cloud comes over and the demand for electricity is retained because it's still hot and humid, but the solar panel is no longer producing electricity because of the cloud cover. That's an imbalance that has to be made up, and it has to be made up instantaneously. And you have to have contracts that allow you to do that. And so that's just one example of the crucial need, which again is going to grow more, not less troublesome because of this increased reliance on renewable resources. Now, APPA, as I'm sure the Commission knows, in conjunction with other trade associations, has commented on the forward contract final interpretation and on the TO NOPR, and there's much that we see that's favorable in both of those, the NOPR and the final interpretation, particularly the construction of the 7-factor test in the final interpretation. But there are lingering issues. And as we've said in our comments, we think the best way to address these lingering issues would simply be, what in our view would be to, consistent with the intent of Congress, is to exclude these commodity trade options from the definition of a swap. So that's it.
I'd actually like to take a little bit of a step back, and I know I do so at the risk of sounding a little bit like Oliver with his bowl in hand. Can I have some more? I know you're probably feeling that why aren't we done with this issue, given its history? But it has a history in the sense that you first started out with saying, well, look to our Brent interpretation, and you came up with a 3-part test, the second of which called into question any contract that had variability as to the delivery term. And that, of course, threw the industry for a loop, because one of the great values and the tremendous benefits of competition, especially in the natural gas industry over the last 30 years, is not just the price effects of competition, but it's the innovation of the services. There's been a tremendous amount of variability and tailored products to meet specific needs, all because of the wellhead decontrol and competition. So the industry understandably had some angst about, are all these contracts now going to be considered swaps? So then you came up with the 7-part test. But then you said, however, and then had another 3-part test, and the general counsel had to come in and give you a 5-part test to explain why the however you shouldn't worry about. And now, well, maybe there's a trade option avenue that we can deal with, and we're all kind of a little confused. And every time that you make a release or a guidance or another iteration of the rule, it seems to raise more questions than it answers. So we can talk about, are these forwards? We can talk about, are these options? Are they trade options? And where do they fall? We just don't want them to be swaps. These are intended to be physically settled. We thought we convinced you of that in one of the iterations of this, and I think we shouldn't lose sight of where we eventually should end up, and that is we shouldn't lose the innovation in the marketplace that's available. In order to, we shouldn't lose that by creating a doubt as to whether these are swaps. So whatever clarity you can provide to the industry on that issue is just make sure that they're not going to be regulated as swaps. Thank you.
Paul? Just for a little bit of clarity, what we're really talking about are firm contracts that are still options. We're talking about options for firm delivery, firm settlement. So there is no question whatsoever that settlement's going to occur. It's the only way that it can occur physically. So we say intended to be physically settled. It's the only way that it can happen. And this has been the case on the power side. You have to have capacity. So if I contract and I have an option for 500 megawatts, somebody has to reserve that capacity for me. They're interlinked. It's not just a standalone. Secondly, that has to occur regardless of the financial implication. So it's just a reminder, we don't exercise these options or these agreements when they're, quote, in the money or out of the money. That is not what is driving our decision making. And the same really holds true for many of the natural gas agreements we've heard, even though I'm speaking as a Southern company. It's not, the gas just doesn't come out of the air. If it's a firm agreement, that has to be reserved somewhere. We bat around a lot the idea of kind of the enterprise rental car example. So I call enterprise rental car, they come drop off a car. I got it in my parking lot. Okay, they've delivered the capacity for me to drive wherever I need to drive. I may choose not to go anywhere because it's too hot outside. I don't want to go anywhere, gas, whatever. But that doesn't mean that I did not receive that capacity. It doesn't mean that I haven't already received it. And I think that example holds true both on the power and the gas side. And I think the concerns you hear are the same ones. I mean, this is one of those topics where we've been kind of saying it over and over again, and you kind of want to have, like, everybody have a T-shirt. If you've argued about trade options before, you get a free T-shirt or something like that. But at the end of the day, we're all still talking about a physically settled agreement. And I think the biggest frustration we may have is if there's one area where it feels like we may have talked past each other, this may be it. And so what I'm really asking for, I can't speak for everybody else, is an acknowledgement that we can use facts and circumstances, which I think are there in the industry as a whole, to help us kind of cross the bridge and not end up with a swap. So.
Amy.
So I just wanted to comment on what Paul said. The one thing that we really don't need, I think, is another circular discussion that leaves us, at least in my case, with a prong 2 problem in the 7-part test. I think there needs to be some specific acknowledgement that zero delivery is contemplated by the 7-part test, or some other type of acknowledgement that these types of contracts are not swaps.
Yes?
I just think it bears repeating that it's every time there is a new issuance, there's a very serious and meaningful look by the end user marketplace to see how we can get to where we want to be. And the reason you have uncertainty is not just because the rules themselves may be unclear, but may be unclear how you apply them to the various types of contracts out there, and there may be disagreement on how you apply it. So to the extent we want something in terms of more clarity in the trade option rule, we're looking for very clear statements that can be used to strengthen that bridge, and we can walk across it ourselves. That's what's been happening, back and forth, back and forth. Counterparties are negotiating these deals and coming up with solutions based on what they have. But the resources, the time, the amount of uncertainty, the fact that you may go out into the marketplace and not get that supply because there's no one willing to do that firm call deal with you, that's a lot to take in and realize that, well, you've got lots of words on paper, but there's something else we need. And to the extent that on our slides or in the comment record, there are proposed ways to just immediately center on this issue and discuss it in full detail in the TO docket, I think that's going to be really helpful because it's going to mirror very closely the work the Commission's already done in the EVO docket, in the volumetric optionality docket. The final interpretation says very clearly in the very last paragraph, in response to a request for no action relief and guidance from energy associations that was filed in the same time period as those comments, that there is, on the basis of that final interpretation, good reason, and it is permissible and expected that the industry will go out and look at what's being potentially misreported as trade options and reclassify or develop nomenclature that would take those contracts or those arrangements out of the trade option world. So you have that language in the very last paragraph of the embedded volumetric optionality interpretation. With the proposed TO language out there, to the extent there's any uncertainty created either by what was not in the interpretation, what's not in the proposal, or by any of the issues that were raised in concurrences to that proposal, those can be resolved, and they will mirror what the Commission's already done. So, in short form, seal the deal. Make it easy for us to take what the Commission's issues and walk that bridge and come up with the right answer.
Well, as there appear to be no further questions, and it's getting to be late in the afternoon, and we've had wonderful information from this panel and the previous panels, I'd like to hand it over to Commissioner for closing remarks.
Well, just on behalf of my fellow commissioners and I want to thank you all for being here. And I think that you can see by the attendance of the full commission here for most of the day, we take these comments made very seriously. We thank you all for the work that went into putting these together. Thank you for coming today. Thanks very much.